the two top issues. And so it likely takes some time for both sides to figure out how to get back really to where they were in Geneva and to put on paper the things that they thought they had agreed to that neither side then wanted to implement.
It's a pretty thorough read-in, Megan. Thank you very much. Megan Cassell outside the White House this morning. Meantime, let's get a news update with our Silvana now. Hi, Silvana.
Hey, Carl, good morning. At least 9 people were killed and another 12 were hurt in a shooting at a school in Austria today. The mayor of Graz says the suspected shooter also died. According to authorities, the male suspect was a 21-year-old former student at the school who had 2 weapons, which he appeared to own legally. Austria's chancellor declared 3 days of national mourning following the incident. Israel says it deported Swedish activist Greta Thunberg on Tuesday after the military seized the Gaza-bound ship she was attempting to travel to Gaza on. Thunberg and 11 others who dubbed themselves the Freedom Flotilla were seeking to deliver aid to the enclave. And 27 states and the District of Columbia are suing 23andMe to block the transfer of personal genetic data as biotech firm Regeneron seeks court approval to buy the company. The lawsuit says each customer should be able to give their informed, express consent in order to be sold. In announcing the purchase, Regeneron pledged to comply with 23andMe's existing privacy policies and terms of service to protect the data. I'll send it back to you.
Okay, yeah, that was always going to be an issue. Silvana, thank you. Silvana Hanau. After the break, Health Secretary RFK Jr. removing all of the CDC vaccine panel experts. We'll look at the potential fallout for the vaccine makers and patients when Money Movers comes right back.
Crypto Watch is sponsored by Crypto.com. Crypto.com is America's premier crypto platform.
Welcome back. Health Secretary RFK Jr. firing an entire committee of vaccine experts at the CDC. That move could have some wide-ranging implications of who receives immunization moving forward. Our Angelica Peebles has more this morning. Good morning again, Angelica.
Morning, Carl. That's right. Secretary Kennedy removing all 17 members of the CDC's Advisory Committee on Immunization Practices, or ACIP, writing in an op-ed that a clean sweep is needed to reestablish public confidence in vaccine science. Now, he claims that the independent panelists have conflicts of interest that have turned the committee into a rubber stamp for vaccines, and he cites a 2009 report that NPR has debunked, and members are required to declare any potential or perceived conflicts of interest. Those are all posted online, where you can see only 3 of them from last year, such as one member participating in Pfizer's vaccine trials. Now, Lyric analysts predicting that increased risk to vaccine manufacturers from this, saying at best this could delay recommendations like for Merck's newly approved RSV shot for babies, and at worst this could upend current recommendations for new and existing vaccines. This morning at the Goldman Sachs Healthcare Conference, Merck CEO Rob Davis saying that it's too early to fully understand what this means and that we'll need to see who's brought in to replace the current group. We should know within the next 2 weeks before the committee's next scheduled meeting. Now, this is the latest move that we've seen from RFK Jr. since he took the helm at HHS and sent shockwaves through biotech stocks. COVID vaccine makers Moderna, Pfizer, Novavax, and BioNTech have all been big losers since Trump took office in January. And that continues a trend that we've seen over the past year that's seen many of those names down double digits. Sarah?
Okay, Angelica, thank you. Angelica Peebles clearing some of that up for us. Joining us now to discuss is NBC News medical analyst and managing director of health innovation at Manat, Dr. Vin Gupta. It's great to have you back, Dr. Gupta, and good to see you. How influential do you think this is going to be for companies and for patients?
Well, Sarah, I think for patients more than anything else, there's a lot of open questions here, because historically in the United States, we look to the Advisory Committee on Immunization Practices to establish what insurance companies, commercial payers in particular, are going to cover. And especially when it comes to vaccine regimens, new shots, whatever it may be. And so the question becomes, all 17 of these experts in the fields of pediatrics, epidemiology, immunology now have been retired, to use their language. Who is going to replace them? And if there is going to be a shift in guidance, what does that mean when it comes to covered access to some of these vaccines? I think that's the question here. And frankly, I'd worry that there's going to be a change to recommended schedules, and that people will see a shift potentially on what insurance will and will not cover.
Why would that not be a good thing?
Well, there's no evidence that changing, say, childhood immunization schedules as guided by leading authorities in the space like the American Academy of Pediatrics, there's no evidence that any of this is necessary. And so we haven't seen any data suggesting that this needs to be revisited, something that's tried and true. And so the concern then will be if a parent wants to get their child vaccinated for, say, measles, mumps, and rubella, or COVID and flu down the road, and they don't meet strict criteria as outlined by ACIP, could their insurance not cover that? The answer right now is yes, absolutely. That's how this works. So then really the question will be, will we see an unprecedented departure, which I think is possible, between what insurance companies recommend and cover, what they will cover, versus what ACIP is going to suggest and recommend up to ultimately RFK Jr.? Is there going to be a discrepancy between the two, that insurance companies go their own way? And there is that possibility. I hope that there will be independence, but historically that hasn't been needed.
You mentioned measles. I wonder if you think this recent outbreak, especially in Texas, where vaccine concentrations especially low, has served as a instructive moment for the administration or not?
I hope so, Carl. What we've noticed too is that the ACIP meetings, multiple ACIP meetings have come and gone. They should have occurred. They were either delayed or entirely canceled. And there was an ACIP meeting right before measles really got out of control in West Texas. And so there has to be, there is a correlation. This just didn't happen out of nowhere, between messaging, soft messaging on the purpose of the vaccines on the part of the administration, and what we're seeing on the ground. I speak to leading pediatric officials on the ground in West Texas just in the last few weeks at Texas Children's. They are now contending with this effort to really push back, have conversations with families that are having divergent views or confused by the messaging coming from the top. And frankly, Carl, it's no surprise to say, what I hear is we don't have enough time in the 15-minute visit to really debunk everything that needs to be debunked. So there is a direct line between what's happening and real patient impacts.
I mean, we don't want quacks, but you have to admit that there's been a public health crisis in terms of trust when it comes to CDC, NIH. You and I have talked about it. We talked about it all through COVID and some of the recommendations. And many of them did come around the vaccine and some of the information that was given to the U.S. public. So how do you deal with that if you are worried about the ramifications of this big overhaul?
I think these big dramatic moves suggesting that there's nefarious intent on the part of these experts, which, by the way, for all your viewers out there, if you want to see the bios of the folks on ACIP, just Google CDC ACIP and you'll get the roster. It's still live until the end of June, presumably, then they will all be retired forcibly. When you look at the bios, Sarah, this is where I would say there's a difference between how this is being framed and marketed. That every one of these individuals had a conflict of interest with a pharmaceutical company, and reality, which is that all of that is forbidden. And all of these individuals are the definition of experts in public health. They're not, making multi-million dollars. If anything, it's the exact opposite. But that's what's being said. And so the narrative here is being painted that there's
himself.
That's what he's saying.
Is saying it, yeah.
And it's factually incorrect. And so I think there's 100%. Two things can be true. Our healthcare system has real problems. And also, by the way, our vaccine committee, the ACIP committee, is not the problem. That is not the problem. And so it's misdirecting our attention on issues that are not the problem. But to your broader point, I think, how do we talk about these issues in ways that don't cause fear, anxiety in more than half the country, or just outright confusion? I think the way the American Academy of Pediatrics has been talking about the COVID vaccine, as an example, highly controversial, a lot of noise. The way they've been talking about it and who really needs it moving forward in the pediatric population, they don't focus on taking away. They're saying they're really focused on under 5, kids without a primary series, pregnant women, really important to get vaccinated, and kids with immunocompromising or underlying conditions. So that's their focus. Who really absolutely needs it? This notion of taking it away from those that don't meet those criteria, I think that's been the frame of the administration versus here's what we're really focused on. So I think it's a pivot that, frankly, if they were to embrace, here's what we're focused on, here's why. It will cause less confusion, less anxiety, but frankly, they're causing confusion and outrage. They're actually angering the people that they're most accountable to, which are providers and patients. They're causing confusion amongst patients and families. They're causing a lot of outrage amongst providers because ultimately we are the ones having to deal with the ramifications of this mixed messaging, and saying that you need to engage in shared decision making or putting out these very abstract recommendations, saying have a conversation. That doesn't help when you have less than 15 minutes to do basic medical care.
No, I think that frustration's clear in your remarks. I do wonder whether or not you think the debate, good or bad, will eventually affect the makers of these vaccines to either de-emphasize their research, spend less money on capital investment, just make development of new vaccines less of a priority.
I certainly think when I look at who are the greatest, the biggest developers of vaccines from an R&D perspective, it's the EU, India, China, the United States. We're number 4, and so we're a big player in the vaccine space. We're not the biggest by a long shot. We're a market when it comes to market access and just a consumer vaccines. We're about 20%. We take about 20% of the pie. But Carl, these vaccine manufacturers, like take Moderna and the contract that was canceled for bird flu, there are other options for these big time vaccine manufacturers to go elsewhere to continue to innovate, like the EU, like China, like India. And so this notion that it's the US or nobody is false, number one. Number two, there's benefits to onshoring vaccine production for, say, preparing for the next pandemic. A very short-sighted decision by the administration to cut that contract, number one. But number two, what happens when inevitably there is a health threat that we have to contend with? Suddenly we don't necessarily own the contract manufacturing for a critical vaccine the way we may have once previously. And what does that mean for access? What does that mean for costs for the American taxpayer to then ultimately gain back some access? It's going to mean we pay more. We probably are going to get less. And how does that in any way set us up to being better prepared? That's where I think a lot of these decisions are one, short-sighted. Two, they're able to talk about this in very short-sighted terms, saying that they're, rebuilding back trust. But at the end of the day, none of this is going to put us on better footing. But that's a hard message to land. Hey, we're investing these things for the future when people are really living in the present. That's hard to talk about, and they're masters of communication.
Well, it was great to have the conversation. It's obviously a big one and an important one. Dr. Vin Gupta, thank you for your time.
Thank you.
Good to see you.
Coming up after the break, one of Silicon Valley's hottest AI startups just announcing a new fundraising round this hour. We'll get some exclusive commentary from its CEO when Money Movers comes back after this.
And Peacock.
Let's get to our Deirdre Bosa this morning at One Market with some big valuation news in the AI space. Morning, Dee.
There's a lot going on this morning, Carl. First, Meta is paying nearly $15 billion for a Scale AI stake. I've confirmed with a source familiar with the deal. The information first reported this new number. A previous report had pegged it to about $10 billion. So this approaches Meta's largest investment ever. Now, a source gave me more color around incentives as well, saying that this is more about Scale AI founder Alexander Wang's AI network, less about the data labeling part of the business. Now, Wang is 28 years old. He's seen as a darling himself in the world of AI. He built critical infrastructure early. He has ties to both Silicon Valley and Washington. Meta, by contrast, seen as falling behind in the AI race. So the Scale AI deal seen as a way for Zuckerberg to get more credibility as he tries to turn around their own efforts. Scale AI, by the way, is a disruptor 50 company. That list just announced this morning. So is Glean. This is another AI startup that just announced a $150 million funding round at a $7.2 billion valuation. Now, that's a more than 50% bump in less than a year. It's cap table. This is also a who's who of Silicon Valley VC, Sequoia, Kleiner Perkins, General Catalyst, Altimeter Capital. The list goes really on and on. Unlike early AI darlings that focused on building foundation models, Glean sits in the app layer, embedding AI into search and workflows across the enterprise. I spoke exclusively to Glean CEO Arvind Jain, who told me what's driving that surge.
Large enterprises are actually they're more worried about this. They don't want to be left behind. The most important thing that I hear from businesses is they are trying to make sure that their workforce becomes AI first.
Now, the data backs it up also. This chart from Goldman Sachs, it shows enterprise AI adoption surged this year, but it still remains below 10%. So it's early days, and that is where the upside is for investors. It's not just enterprises, though, and startups making moves. Not a slow news day, never a slow news day in AI. Some of the most powerful companies in tech are making moves also. Reuters this morning reporting that OpenAI has struck a surprising deal with Google Cloud, even as Microsoft remains its largest backer, a sign that control over the different layers of AI is shifting, even splintering. OpenAI branching out from Microsoft, Google leveraging its in-house AI chips, those are called TPUs, to power even its rivals. And then that Glean funding round, Scale AI, it all shows that there's more room for startups to compete, not necessarily by building the models, but by making them useful. And that is, again, where the investor upside may be shifting, guys.
Okay, Deirdre, thank you very much. That was a lot you got in there, Deirdre Bosa. Sticking with highly valued AI plays, CoreWeave surging close to 300% now since its IPO. But one Wall Street firm is doubling down on its call to sell the name. The analysts' warnings on the other side of the break, and the stock is down a little more than 5%.
Take a look at shares of CoreWeave, one of the hottest AI names of the year, as you know, under pressure now, following a new note from our next guest, reiterating his underperform rating and his target of $36 over concerns around the company's recently disclosed financing structure. Joining us this morning on the phone is D.A. Davidson, head of tech research, Gil Loria. Gil, appreciate the time this morning. Talk about your call. To what degree has it been difficult to defend, as the stock has obviously soared?
Yeah, I mean, we're just going back to basics here. We're dusting off our Finance 101 books and saying that if you were to take a 10% margin loan and use it to buy a bond that pays a 5% coupon, you're destroying value. And we think that this is what's going on here. Clearly, it's easy to get excited about AI. We're all excited about AI, and you're excited about stock going up a lot, but if you look under the covers and the more work we do, and we've done a lot of work on CoreWeave, the more we realize that is the case, that they are, that all their cash is going to pay down debt. There really isn't anything left over for shareholders. In terms of the stock activity, very low float. It's impossible to short. So this is more reminiscent of what happened with AMC. AMC wasn't a good business at $3. But people got so excited that they bid it up to $300, and it's back to $3 today. This is just a matter of timing until either the lockup expires at the end of September or there's an early lockup expiry or a secondary, and that'll take care of the price discovery around CoreWeave.
I mean, Gil, the bull case, it's right. It's demand, growing demand for AI infrastructure. It works with the best and the biggest, which is NVIDIA, marshals those high-end chips. How do you dispute that?
We don't dispute the part about AI booming. There's an extraordinarily growth in AI. We just think there's a lot better ways to invest in that. Microsoft, if we were to go back to my return math, Microsoft has a 21% return on invested capital. Their cost of capital is 5%. They create a tremendous amount of value. There's another company called Nebius that is a pure play AI hyperscaler that doesn't have this debt structure that actually creates value for its shareholders. And actually, interestingly, Deidre talked about Scale AI and the fact that it's now valued at nearly $30 million. Nebius also owns the second biggest AI data company. So there are better ways to invest in AI that will return value to shareholders, not to lenders.
It does sound, though, Gil, like you acknowledge that the expansion of the model could last a little bit longer, right? How much pain are you willing to endure on this call?
We don't think that it's going to take very long. Again, the lockup expires September 24th. There may be some early expiry. At that point, the stock will be freely traded. Let's not forget that before the IPO, a lot of people did a lot of work on CoreWeave and concluded that they weren't willing to pay more than $40, and they were only willing to do that because NVIDIA stepped in the last second to participate in the IPO. We think that when the stock is openly traded, freely traded, liquid enough, that people will do the same level of work and the stock will come back down.
Yeah, we remember those early days after the issue. Gil, it's an interesting call, certainly moving the stock today. Good to talk to you as always. Gil Loria over at D.A. Davidson on CoreWeave.
What stands out is just the resilience of the market and the fact that we continue this slow and steady build through the morning as we have in recent sessions. And the S&P is up another 0.25%, but that just puts it, again, within 2% of an all-time high.
Yep, got a little air pocket, managed to recover. We'll keep our eyes on the ticker for headlines about London. In the meantime, let's get to the half back out the West Coast.
Okay, Carl, thank you very much. Welcome to the Halftime Report. I'm Scott Wapner here at One Market in San Francisco. Front and center this hour, the surging tech trade. The sector up big over the past month, and that has sent stocks within spitting distance of a new all-time high. We will discuss. We'll get the trades to make right now with the investment committee. Joining me today, Brenda Vangello. Big Technologies' Alex Kantrowitz is with us here on set. Malcolm Etheridge along as well. We will check the markets here where we are in the green across the board. We, of course, are still waiting for some headlines to come out of those now completed meetings in London between the United States and China on the issue of trade. We'll track that too. But the S&P and the Nasdaq up 5 of the past 6 days, Bren. And we're on the march, as I said, to new highs in large respects because of this trade. It seems from the commentary today that we are going to take out those old highs. It's just a matter of when, not if.
Yeah, I think if we look at what's happened within the technology sector, it was such a laggard during the first quarter. There were so many concerns over whether spending on AI was really going to continue at the pace that we had experienced last year. And what we learned is that actually corporate earnings were fantastic for the group. They were a leader during the first quarter, and valuation was attractive at a certain point back in late March, early April. And so we've seen a really big resurgence, and the group continues to be a leader, a projected leader for next quarter in terms of overall revenue growth. So I think as long as the growth can stay intact, some of these names can continue to work. Although I will say that there are some where growth looks like it's going to be a little bit more challenged and valuation's still high. So I don't think every name is a value in this group.
Yeah, Malcolm, Barclays today says the path of least resistance is to the upside. Wolf Research, new highs are ahead. You feel the same way?
Definitely feels for the moment that the tech trade especially is intact, but I will say that I'm growing a little bit more skeptical of this market at 22 times on the S&P, where, as you just pointed out, we're still waiting on some substantive news coming out of the trade talks with China, let alone all the different regions where those trade pauses are set to unravel toward the end of this month, at least, that 90-day pause that a lot of those countries got. And we really haven't gotten any clarity there as far as tariffs. So I think that we should at least be cautiously optimistic, but I definitely understand that the momentum is on the side of pushing past those February highs.
What about the idea, Malcolm, that it might not necessarily take all that much in a readout of what actually happened in London to get stocks moving higher again? Maybe the bar is reasonably low at this time, just thinking that any incremental advance deemed to be positive is going to be good enough.
I think that's true probably for the next 3 or 4 weeks, right? We're heading into a period where we're going to get Q2 earnings, and I think that's where the real rubber meets the road. We're going to get guidance from those CEOs of the retail institutions. We're going to get guidance from the banks, all of those that are really being hit by those tariffs and have a lot more clarity now on the impact of those tariffs, even though they don't have a lot of clarity as far as the roadmap for where we go from here. Is it 30%? Is it 20%? Is it 10%? We still don't know. But I think just getting guidance from those CEOs of what earnings will look like the rest of this year will really be the telltale sign for markets in the second half.
As we said at the top, we're not even talking about new highs without the resurgence in tech. Dee Bosa's here at One Market, as she always is, with what's been driving that comeback, Dee?
Well, a lot of it has to do with the AI trade being back, not just because of hype this time, but because investors, they're finally seeing enterprise deployment, strong infrastructure demand, and this is key, monetizable scale. Now, just consider some of the recent headlines over the last few days and this morning. OpenAI hitting $10 billion in revenue, Glean raising it a more than $7 billion valuation, Microsoft, it's at all-time highs, Google powering its own rivals. This is all part of the same shift that underscores we are still in early days. Now, take this chart from Goldman Sachs. Enterprise AI adoption, it surged this year, but it still remains below 10%. So it's still early, and that is where the upside is for investors. Now, look at the public stocks. Alphabet is up 8% since its I.O. keynote. NVIDIA is up more than 20% over the last month. A lot of that on inference demand and sovereign AI, despite China challenges. And then CoreWeave, of course, the meme stock of the AI world. It's nearly tripled over the last month. The private trade, Scott, it's booming too. New valuations for darlings like Scale AI and Glean. Now, this morning's report about a new and surprising Google Cloud OpenAI partnership, that's also positive for the tech trade at large. It means that demand for AI infrastructure, it's outpacing even the biggest partnerships. If that lasts, that will continue to run this trade. But of course, when we get to next quarter, investors are going to again want to demand to see return on investment from all of these investments.
All right, Deirdre, thanks so much. That's Dee Bosa really setting the table for us. I mean, everything's up a lot since the April low. I think everybody knows that, too. But technology far and away the best. It's up 34% and comm services up 26%. Big Technologies, Alex Kantrowitz is at the desk with us, too. The news that Deirdre brings about these new developments from the hyperscalers and the deals they're cutting really only underscores why money continues to flow to these names from investors.
Absolutely. With AI, what we've seen is that in hard times, it's an efficiency play. In good times, it's an expansion play. And so we now see leaders like OpenAI taking off some of the restrictions from the early moments where it could only work with Microsoft. It partnering with Google, as Dee mentioned, is a very big deal, right? Because now you see that it's able to take its leading technology and sort of spread it across the entire ecosystem, maybe outside of Amazon at this point. And that bodes well for any company looking to build with this stuff, because the real opportunity for growth here is outside of ChatGPT. It's companies that are trying to figure out ways to implement this in their workplaces and use it for that efficiency and expansion. If you have access, let's say you're a Google Cloud customer and you have access to OpenAI now. If you're a Microsoft customer, you can get everything. An Amazon customer, maybe you're still working with Anthropic or Amazon's Nova models. This idea that you can now basically take the best in breed and implement it should lead to an expansion of building, whereas these previous deals have held it back.
What I think is so interesting, too, is that competition here is so fierce, right? We talk endlessly about an AI arms race, but you don't generally have arms races where you have competitors doing deals, in some cases, with each other. Despite the rivalries of the OpenAIs and the Alphabet, Googles, and what have you, you still, in some cases, have to do deals with your perceived rivals to get ahead. It's who has the better technology that you need to be willing to embrace.
Silicon Valley is all about frenemies, right? You got to have these partnerships. Think about OpenAI. What they built, that was right on top of Google's innovation, because Google wrote the paper that basically ushered in this moment of generative AI with the Transformer paper. And so you have OpenAI building on top of their innovations, and Google is building right back. Every single company here pushes the cutting edge forward. They understand that there is room for a tremendous amount of growth throughout the entire ecosystem. You have multiple companies that are over $3 trillion. That doesn't happen if one company takes all the gains. So I think you're right to point out that you have to work with your rivals. And if you do, it's sort of like may the best technology win. And we see that there's a leapfrog every couple days. And each company that's trying to be the leader thinks that it has the capabilities to leapfrog next. And that's why they play this way.
It's so interesting, too, that what is the best technology today may not be the best technology, quite literally, not just figuratively, tomorrow. And that's the way that we need to think about all of this. You own Alphabet. Bren, you own Meta. They agree to take a 49% stake in the data labeling firm Scale AI for $15 billion. Our Dee Bosa confirming that, as she just did a few moments ago. So how about both of those stocks?
Yeah, I think about both of them a little bit differently. With Google, at Alphabet, we are a little bit concerned just about how the evolution of traditional search ultimately ends up and what happens to their business model. No doubt that Google has a ton of data that's incredibly important. They've invested a ton of money in AI. Gemini is completely legitimate and competitive in the marketplace. But what happens to their traditional advertising-driven search model? With Meta, I think we're seeing that the investments they're making in AI is paying off with advertising. And I think they were ultimately, that platform, I think, is positioned to be a continued winner in this environment where traditional search is being disrupted, traditional media is being disrupted from an advertising standpoint. So I think that when we look at a place like Meta, where they're making more investments now, I think we had an announcement just today about further investments in AI from Meta, I think partially to justify their CapEx guidance, which was higher last quarter. That's been a source of some controversy, but I do think the company is making the investments where they need to make them and is really positioning its model to continue to be a winner in this environment.
Back to the arms race, AK, Mark Zuckerberg personally hiring to create a new, quote, super intelligence AI team, according to one report today. What does that mean to you?
Well, Meta has been really working hard to further the state of the art in open source artificial intelligence. But the problem is it hasn't worked according to plans. Llama 4, their latest model, was largely viewed as a disappointment outside and inside. So they needed something to supercharge that company. Now, super intelligence, that is a jargon word, it's a hype word. But I don't think we should look past what they're doing with this acquisition, or it's sort of like an acqui-hire-zition, because they're going to get 49% of the company. Alexander Wang is going to come on board. I spoke with him right before New Year's, talking to him about where he thinks AI is going to go this year. He's interesting for a couple reasons. First of all, he fits perfectly with that company in terms of his political adeptness. He has been very close to the administration. He speaks to the people they speak with. Now, maybe this is a weird data point, but he was on the Theo Von show, which is sort of becoming an indication that you're kind of in with that crowd. And that was a great episode. But also, his bet is very interesting. He's betting on using data to scale AI models. We talk a lot about NVIDIA and the infrastructure side, but there has been a undercurrent in Silicon Valley that if you don't have the data, it doesn't matter how much compute you have, you're going to eventually hit a wall. So scale is all about building that extra data source for artificial intelligence. In some case, hiring PhDs to feed information into these models so the models get smarter. And if what Mark Zuckerberg saw was that compute is hitting a wall, remember, he has so many GPUs. They've had the lead because they needed them to optimize Instagram. If he saw that wall and said what we need to get to the next stage is going to be data, he just partnered with the perfect company.
Yeah. It's interesting, too, when you look at, as we say, this resurgence in tech has stocks really on the doorstep of a new high. We're talking 2% or so on the S&P 500. What was a terrible trade for a while has turned into a great one, and that's the semis. The SMH ETF is up 44% off the April low. Some of the components within there, it's just astounding the gains that we've seen. Microchip, a double. Micron, 74. onsemi, 70. And on. The SMH is up 5 of the last 6 days. Christina Partsinevelos follows this so closely. She joins us now with more on why these stocks are moving yet again.
Yeah, they're staging a comeback with, just to add more stats for the SMH, the ETF heading for its third straight weekly gain driven by specifically strong earnings and shifting policy wins. So the biggest catalyst today is a White House official signaled President Trump could ease chip export restrictions to China in exchange for faster rare earth exports. So a rocks for chips deal that could help names like AMD and NVIDIA. NVIDIA's dominance got another boost when Huawei's CEO admitted their chips still lag U.S. peers by a full generation. This according to Chinese state media just over the last 24 hours. NVIDIA's CFO reinforced this edge just last week at GTC Paris, citing margin recovery and improving Blackwell supply. And that's why you're seeing shares up 22.5% just in the last month. And the momentum's spreading. Micron jumped 3% today after announcing they're shipping HBM or high bandwidth memory HBM4 36 gigabyte samples to key customers, while TSMC gained about 2% on a 40% year over year May sales spike. TSMC now on its longest winning streak since December 2023. That's 7 straight days in a row. And then here's the key metric, Scott, to your conversation. SMH has really climbed 16% this past month versus just 6% for IGV, which represents software, and 6.5% for the SPY ETF as well, which really signals a performance gap and a clear rotation back into hardware as AI infrastructure builds and those geopolitical risk ease. Scott?
Christina, thank you. Christina Partsinevelos. Let's not kid ourselves either. You go back to NVIDIA's earnings day, which was so highly anticipated, and you needed that to go well for this trade to continue to work. It did, in fact, and that in many respects is why we find ourselves here today as well. Brenda, you own that stock along with Broadcom.
We do. And what we've seen, obviously, when NVIDIA reported, the market was in a much different place. But now we have, and when Broadcom reported recently, they reported a perfectly fine quarter, gave strong guidance. AI is really continuing to drive that story. Even the non-AI semiconductors stabilized a little bit more than I think everybody had expected. But the stock had a bit of a ho-hum reaction. So I think it's just telling that this group has come a long way fast, and the expectations are pretty high. Still believe that it's an important exposure to have in a portfolio, absolutely, and that there will continue to be ongoing demand as AI infrastructure spend continues. That both of those names will be very relevant and important, but have to be mindful a little bit of how far we've come, and that expectations just ratchet up as they get more expensive.
Malcolm, they may have come really far, really fast, but B of A, for example, and I'm assuming many others are still bullish on the space. They put out a note today because of demand trends, data center and AI levered companies like the NVIDIAs of the world, the Broadcoms, the AMDs, and the Marvell. You own in the very least of that group, NVIDIA too.
And Brenda pointed out the fact that they've come so far so fast. I think it's really important to point out the fact that they're really pegged to, I would say, Broadcom and NVIDIA. Whatever direction NVIDIA goes, we saw NVIDIA's earnings basically touting the demand that still is there and their ability to ramp up production to meet Blackwell demand. Now we're hearing that they have to actually increase production even more to meet that demand, and that's a very positive signal for the entire sector. So I think it's still that same trade. As NVIDIA goes, so goes the rest of the semis trade. So I think investors should just be very cautious to pay attention to how fast this trade has run and be concerned a little bit about how much further it can go instead of maybe considering the fact that this is going to continue to run at this pace throughout the rest of the year.
We're watching Apple shares today, too, which are modestly in the green a day after the highly anticipated WWDC. It's what brought us out here to the West Coast in the first place. Steve Kovac was alongside us yesterday. He's here today with some reflections, as everybody has now had some time to take everything in that happened yesterday, in which you put on social media, you called it, and this is cold, man, the Worldwide Meh Developers Conference. Why was that your big takeaway?
It's not just my big takeaway, Scott. That's what the street is saying this morning, too. It's just, and that was, by the way, I was linking to the Cramer's Investing Club's takeaway when I tweeted that. But look, the street has the same thing reaction that we had right after the event on closing bell yesterday, and it was just kind of lackluster, muted. If you're hoping for more artificial intelligence announcements, you didn't really get anything groundbreaking. Let me just show you what the street's saying right now. UBS, more evolutionary than revolutionary. Melius, nothing that moves the needle, and so on and so forth. There are some positive sides, and you do have some analysts also, on the other hand, saying, like at Goldman and Morgan Stanley and so forth, giving some more positive reactions, saying, you know, the foundation is there, the groundwork is there for artificial intelligence. It's just going to take more and more time. One thing that I did digest a little bit overnight, though, Scott, is this idea that developers, this was the biggest announcement probably on the AI front, developers can tap into Apple's AI model on the phone, so it doesn't have to either pay OpenAI or one of these other cloud-based services. This is a way for them to kind of save costs and develop an Apple's AI ecosystem. That is one kind of carrot, if you will, to keep developers making AI stuff on the Apple platform. But we'll have to wait and see how the rest of the week goes and how developers are reacting to the tools Apple is giving them. And at the same time, the competition is just not stopping here. So we're now spinning it forward. A lot of the street also saying, let's wait for some cool hardware. There's some optimism about this new thin iPhone coming out. And then even further out, next year and the year beyond, the anniversary editions of the next iPhone, believe it or not, hitting close to 20 years, and some new foldable form factors and things like that that might juice some excitement. But for now, Apple's kind of sitting AI out, Scott.
All right, we'll see what happens. Steve Kovac, thank you once again for setting us up for our next conversation. Eric Woodring is Morgan Stanley's star analyst. He covers this company, and he joins us now. It's good to see you, especially the day after this event. And you heard the commentary not only from Steve, what feels to be sort of pervasive here. Fails to clear a low bar was a headline. Lackluster, meh, nothing that moves the needle. Does that match with your own takeaway?
I think those are generally fair takeaways following the developer conference, Scott. You know, I think the problem, and your prior guest alluded to this, is the market in the industry is moving so quickly. And if we rewind back to the developer conference of 2024, we got a lot of features that Apple previewed that were very excited the market, excited consumers. And we want to see progress towards those goals, towards those targets. We didn't get much. Software head Craig Federighi talked about having a more intelligent, more personalized Siri coming in the coming year. Listen, the market is very impatient when you see the quick pace of AI development. And so it's a combination of what we got wasn't necessarily what we're seeing from others. And then what we are seeing from others is moving so quickly that the concern is that Apple will be left behind. Now, I would mention that historically, we've seen Apple come in late to technologies. They kind of see how the market develops. They try to create something that is better, and then they try to take all of the profits. And so it's not necessarily unusual to see Apple somewhat late to technologies. And as your previous guest mentioned, adoption of these technologies is still very early, but the name of the game is progress. And what we didn't get at the developer conference was tangible signs of significant progress. We got steps forward. Opening up the large language models for developers is an important step forward, but it's just not enough when the pace of the market is as fast as it is right now.
Yeah, it's hard for, I guess the analyst and the investing community to have to rally around another P word, that being patience. We're sort of tired of being patient, but you make a good point. It's one that we raised with our group yesterday. Traditionally, Apple marches to its own beat, its own drum, its own timeline and time frame. They don't really care what the investment community nor the analyst community really wants. They'll deliver what they think they can deliver when they're ready to deliver it. And history's been on their side.
That's correct. And again, I think it's very easy to take a step back and think about how we all use our Apple devices, whether it's our phone or the ecosystem of our devices, and say, let's kind of dream the dream. If Apple could deliver a very high quality kind of virtual digital assistant that is voice controlled, they have the data, they have the user base, they have the privacy standards, they have the ecosystem. So these functions can work kind of across all of your different products. They have the partnership with OpenAI. They're seemingly willing to make partnerships with other large language and foundation model providers. It's very clear, or I think easy, to look forward and say, we can envision a world where Apple is a clear winner in this AI trade. But then you take a step back and again, you think to last developer conference and you say, well, we're not at the point of where even the company introduced some of the features a year ago. Again, it's this patience factor that I think investors are not willing to tolerate right now. The stock trades at 25 times earnings on calendar 26 numbers. Over the last year, it's traded kind of 25 to even above 30 times. And so the market has discounted the multiple to say, we're concerned about growth, we're concerned about predictability, we're concerned about the competition within the AI landscape. And until we as the market feel better that things will be moving forward with kind of more tangible, larger steps, the valuation multiple will have a ceiling on it.
Yeah. That's a good place to leave it. Appreciate your time very much. Eric, we'll see you soon. That's Eric Woodring of Morgan Stanley joining us with his first take on what happened yesterday. Malcolm, you told us right after it ended yesterday that maybe the stock was attractive here, that maybe you were thinking about adding to it. What about that? Did you? Would you? Will you?
Yeah, so I haven't found the opening yet, but I do think we've reached what I'm referring to here as peak pessimism around Apple. We started getting analyst calls almost 2 years ago now, at least starting to sound the alarm when we saw declining iPhone sales start to kick up around then. We've seen the issues with tariffs related to China. Obviously, that's going to impact Apple more than a lot of other companies. We've also seen the lag in AI development that's been covered a ton. There's all the reasons that, investors may not be considering Apple. It's the reason it's lagging behind its peers significantly, like a Microsoft or a Meta right now. I'm thinking that this is probably setting up to be the place where you want to be adding shares somewhere in here. We saw right after Liberation Day, I think it traded down as far as 172, somewhere in that range. So we know that that's roughly where the floor is as far as bad news in this name, where right at the 50-day moving average, but momentum's not on its side. It's well below the 100 and 200-day. All of those things together, I think that we're probably on the cusp of a hardware event that is actually going to impress. And I think that we're probably setting up here for Apple to make some sort of announcement that does get investors excited again. And I think that all of the conversation we're having around WWDC and Apple specifically really reiterates just how important it is that a company like this gets this right, because Apple is reflective of how much opportunity there is in what I'll refer to as consumer AI, where everything else we've been talking about to this point has been strictly in the enterprise.
All right. We're going to take a quick break. We have a move of Malcolm's to get to today, and we certainly will. We also have our call of the day, a rare one at that, a double downgrade from Mickey D's. Doesn't happen all that often. We're back in 2.
Garden centers.
All right, welcome back. Our call of the day today, a double downgrade for McDonald's at Redburn Atlantic. Kate Rogers is back, and we are so happy to have you back, and you have the details for us.
Thank you so much, Scott. Great to see you. So Redburn hitting McDonald's with that double downgrade this morning to sell from buy on concerns over GLP-1s leading to declining foot traffic, coupled with worries, of course, about the economy. It also lowered its price target to $2.60 from $3.19. McDonald's often performs well during economic slowdowns, but clearly Wall Street is challenging that narrative. The issue here is value and consumer perception around costs as restaurant inflation continues to outpace grocery costs. On the GLP-1 front, the note refers to behavioral science. So if one person in a home is on one of those drugs, that reshapes dining habits for an entire family. Worth noting here, this is the third downgrade that McDonald's has seen in the last 2 days. The note says foot traffic declines are expected at lunch and dinner and will impact not only McDonald's, but also other chains, including Domino's and Yum Brands KFC. Scott, back over to you.
All right, Kate, thank you. That's Kate Rogers with a rare double downgrade. Malcolm, you have any interest in this name? Have you ever owned it? If not, why?
Haven't owned McDonald's. Don't love anything, especially right now, that's tied to consumer spending, as we keep getting stories about whether the consumer is actually slowing down or not. But I do think the one positive buried inside of McDonald's is their growth plan and their plan to add additional franchisees and open additional stores from here. So if you are looking through at where the profit engine is going to come from, it's going to come from them collecting those upfronts with new franchisees coming into the system.
I mean, for a double downgrade, down 1.25%, not that big of a deal, at least from the market standpoint today. JP Morgan's price target in terms of other calls raised to 320 from 300 at Wells. That's Mike Mayo, the well-known analyst over there. You own the stock?
We do. And I think if we look at, JP Morgan is the most dominant bank in the U.S. And I think we're in an environment where large banks are going to continue to gain market share, just as we move to the digitization, AI, how that impacts the consumer experience at the bank. So there are a lot of investments that these large banks have the ability to make that small regional banks do not. And I think that's going to continue to set them apart. So we continue to own JP Morgan. We've owned it for a long time. It's our only position within banks.
Oh, the only one.
It is the only one in traditional banking. So we're sticking with it.
How about Disney, which you own as well? The price target to 130 today, reiterated by at Loop. They finalized the Hulu purchase from our parent. What do you think about this name from here?
Yeah, so I think the Hulu purchase was really a lot lower cost than was originally speculated it could be. And this will allow them to really leverage Hulu and do more bundling with Disney+. So I do think it's a positive. And overall, this name has really recovered quite nicely. Trends have picked up. I also think this deal they have with the Abu Dhabi location is fantastic. I mean, they're not paying to open it. They're just going to manage it and collect a service fee. And so that, I think, is a great economic proposition for that name, as well as just great for the brand overall to expand more globally.
Let me get your take on Tesla while I'm on this topic, because there were two more calls on it today. There were a couple yesterday as well. Reiterated underweight today at Wells, $120 is the price target. Reiterated underweight at JP Morgan today, and there were a couple of downgrades yesterday. And this fallout between Musk and the president, where that goes from here, and whatever ramifications there are resulting from it. How do you view that stock today?
Yeah, so obviously it's a bad moment in terms of PR for Elon Musk, but I actually do think the more I've thought about this after this breakup happened, I actually think it's the best thing for both parties because Elon can distance himself from the president. I think that's hurt some perception of Tesla, especially in certain areas of the coast. But when we look at the company overall, I mean, this week on Thursday, we have the robo-taxi event. That should be a catalyst, or at least give us a view view of how that project is coming along. Then you have the lower class vehicles, which are coming down the pipeline, robotics. So there's a strong pipeline there of innovation that I think we don't see in a lot of large companies. It's a highly controversial company, highly volatile stock, but we're sticking with our position.
Okay, Malcolm, I mentioned that you had a move to come out of the last block. It's a sale that you've made, and it's the cybersecurity ETF, the CIBR. Why now? Simply because of the gains that we've seen from many of these stocks that are within that index, that ETF?
It's yes and. So it's up 6 of the last 7 weeks. It just put in a new 52-week high last week, or a new all-time high last week. And that actually scares me a little bit, makes me look under the hood and see what's really driving that. And if you look a little closer, you notice that it's Broadcom that's actually number one, the top holding in that portfolio at like 9%. And then rounding out the top 5, you got Infosys and Cisco. And so it's not necessarily one that I plan to get out of and stay out of, but after they rebalance and reset the holdings, the weighting in those holdings a little bit, we'll be looking to get back into it. But to your point, with us up more than 30% since we got into it last year, with it meant to be a tactical overweight to play that cybersecurity trend, I think it was a good place to take some profits and just wait and let the rebalance happen.
Does it feel a little crowded to you? I mean, how do you view this space?
Yeah, I like what Malcolm's saying. The shifting balance in that ETF doesn't seem right to me. However, I will say that this space is definitely going to be a big one. If you think specifically about AI, and AI drives so much of what we see in technology today, we have very powerful open source artificial general intelligence models, generative intelligence models, like DeepSeek, for instance, that bad people can get a hold of, deploy on their own machines, and then send very personalized phishing attacks out to folks. So I expect that we're going to see an increase in these type of attacks, and therefore cybersecurity is going to be very important. And by the way, this isn't just text; it's moving into voice. So you could have people's voices cloned and then call their family, like our family. We have a code word that if somebody calls and says I'm in trouble, we ask for the code word because if you don't give the code word, you might be an AI voice. And so I don't think most families have that. So I think we're going to see so much more. I think that probably extends beyond just like this traditional cybersecurity companies, but this is going to be a very big issue. So if you can invest in the companies trying to prevent it from happening, I think that's a pretty good idea.
All right, let's get the headlines now with Silvana Hanau. Hi, Silvana.
Hey, Scott, good afternoon. U.S. Ambassador to Israel Mike Huckabee told Bloomberg News today that the U.S. no longer wholeheartedly endorses an independent state for Palestinians. Huckabee said there needs to be significant changes to the culture and that it probably won't happen in our lifetime. Asked if a Palestinian state even remains a goal of U.S. policy, as it has been for decades, he said, quote, "I don't think so." House Speaker Mike Johnson said today that California Governor Gavin Newsom, quote, ought to be tarred and feathered over the protests in L.A. because he's a participant and an accomplice in them. Newsom and State Attorney General Rob Bonta sued the Trump administration yesterday, claiming the state's sovereignty was trampled when President Trump ordered the guard troops to immigration protests in L.A. And Uber is teaming up with startup Wave to test self-driving vehicles in London. The companies say they chose London because of its different road layouts and traffic laws compared to the U.S., where most testing has been done so far, Scott. I'll send it back to you.
All right. Silvana, thank you so much. Silvana Hanau. Coming up next, AI-driven investing. We'll hear from the co-founder of Portfolio Pilot, how his company is looking to revolutionize the way you invest with the help of AI. Halftime's back after this. All right, welcome back. Our next guest company bills itself as the world's first AI-driven personal investment coach. Alex Harmson is the co-founder and CEO. He joins us here at One Market of Portfolio Pilots. Good to see you again.
Hey, thanks for having me on again.
It's been a while since we've spoken with you. Last time we had you on in September of 23, you had 13,000 users, $6 billion in assets on your platform. Now you have 30,000 users and some $30 billion in assets on the platform. How have you achieved that growth?
It's been exciting, absolute, massive excitement. The biggest thing I think is that, I don't know if we're quite ready for AI to manage your money for you, but the idea you could hook up your finances, accounts, answer a few questions, and then have AI find optimization opportunities for you. I think just as the Overton window expands, as people get more comfortable with AI, that feels like an obvious solution. And we actually have a lot of people just reach out and find us. Sometimes even ChatGPT or Perplexity sends people our way, as they're looking for this kind of solution these days.
So to be clear, and you underscored this at the top, AI, your platform doesn't use AI to actually manage people's money, but it does in terms of, I would put in my personal information, my net worth, this, that, and the other, and it comes back to me with what?
Proactive financial advice. And so actually the parent company behind Portfolio Pilot is a registered investment advisor. So we can actually give you an individual fiduciary financial advice, everything from specific investment advice on how to increase your risk-adjusted returns, increase your downside protection, lower fees, optimize your taxes, think about long-term retirement planning, estate planning.
Actual stock picks and investment choices or no?
Individual stock picks, ETFs, mutual funds, crypto, even takes into account your house, jewelry, cars, private equity, student loans, truly across the board.
How does it work, though, in an environment like the one we're in, where we're so susceptible to, it's a headline-driven market, it's in many respects, the people who come on and say it's a stock picker's market. I can understand this working well in what is a set it and forget it environment where everything seems to be going up and you generally have the assumption that it might continue to do that for a while. But what about in this kind of environment? How accurate is it?
I think this is one of the best things about having a platform like AI, trying to remove a lot of the human bias from the situation. It's very focused on long-term investing. And so we're not trying to say, you should buy this stock today because it's really hot, because it's reacting to the tariffs. It's for, the 80% of people that want to be somewhat involved in their finances, that know there's optimization opportunities that must be there across all these different accounts. They're not trying to trade the market every single day. And so for them, a lot of it is about making a more efficient portfolio, finding high expected return, low correlated assets, and then making sure you have the right mix of downside protection at your risk level with the lowest fees.
It's $29 a month for what you call a gold platform, and platinum is $100 a month. $100 a month is a lot. What am I getting for a platinum subscription?
It is a lot. This $99 a month tier, the platinum tier, is mostly for people that want to be a little bit more involved, actually interact with the agent. We have this AI equity research tool. But Scott, for most people, the $29 a month tier is perfectly fine. It's $20 if you buy an annual plan. And our hope is that it pays for itself with tax optimization opportunities on its own, and thinking about even a small increase in your expected return or small decrease in your downside. Our hope is that it pays for itself, it doesn't break the bank, and is something that is mostly just there in the background to give you this sort of proactive optimization advice.
All right. Appreciate you being back with us. We'll follow the trajectory of your company.
Wonderful.
Alex Harmson, thank you.
Thank you so much.
All right. Up next, Mike Santoli. He's back with his midday word. We are back on the halftime report today from One Market. Our senior markets commentator, Mike Santoli, is here with his midday word. What do you make of the price action today?
Upward grind, Scott. When the market's in wait-and-see mode, which we clearly are, we're digesting 2 strong weeks, which came at the end of 2 very strong months, it can kind of waver and find excuses to back off. That's not what we're doing. We're sort of finding ways to stay supported up near these levels. Today's high in the S&P, where we are right now, is a marginal new high for this move. So grinding toward progress, but supported by the parts of the market that haven't as much participated, that are maybe more risk-seeking. You have the Russell 2000 outperforming again, up 0.75%. I also was looking, the 20 best performing S&P 500 stocks year to date, 17 of them are down today. Of the 20 worst performing stocks year to date, 17 of them are up today. So clearly money just kind of looking for places that haven't moved as much yet. That can't last forever. Obviously, you're going to need some of these cards to turn over in a favorable way to keep going here. But volatility continues to leak lower. The VIX now below 17. So everything seems, pretty comfortable and benign for now. We'll see if the headlines cooperate with that.
Yeah, slow and steady. I'll see you in a bit, Mike. Thank you. Yep. That's Mike Santoli, our senior markets commentator. Up next, CNBC unveiling its annual Disruptor 50 list. The company's generative AI revolution is transforming that list, as you might expect. We'll have the details next. CNBC unveiling its 13th annual Disruptor 50 list today. Julia Borston joins us now to discuss. Give us more information on this.
Well, we've really seen the power of AI impact this list. There are so many companies on this list that say AI is an essential technology. In fact, 21 companies on this year's list say that AI is an essential technology for generative AI is an essential technology for them, up from 13. And if you look at AI more broadly beyond generative AI, 38 companies on this year's list say that AI is critical to their business, up from 34 in last year's list. And just looking at the top 5 here, Anduril in the #1 spot, Scott. This is a big deal here to have a defense tech company in the #1 spot. OpenAI at #2 was the #1 company both last year and the year before.
It is interesting. You had to figure, too, Julia, that AI was going to be the central theme in all of this, of course.
Certainly. And what's fascinating is if you look back at before ChatGPT launch, which was really that pivotal moment for the tech ecosystem, only 11 companies on this year's list were on the list before ChatGPT launch. And many of those companies have really embraced generative AI. Anduril, a perfect example, has really leaned into AI. Canva, #5 on the list. That was a design platform, and they've leaned so heavily into AI just in the past couple of years, really integrating partnerships with ChatGPT and the like. So the story here seems to be, if you want to succeed in this tech landscape, AI has to be essential to your business. AI is the new technology.
Yeah, no doubt about that. Julia, thanks so much. That's Julia Borston. And on that note, we have a special closing bell coming up from One Market in just a bit. A look at the next wave when it comes to AI, the people, the companies, the trends and technologies that will drive this revolution forward, and of course, how you can invest in it. We'll have exclusive interviews today with the AWS CEO, Matt Garman, Andreessen Horowitz General Partner, Anj Midha. He was the first outside investor in Anthropic. VC Jeff Richards with us today, along with portfolio manager Ankur Crawford. She invests heavily in the AI trade. We'll do final trades next. Two final trades. Malcolm, what do you have for us today?
Yeah, believe it or not, I'm going to go Apple. With all of the coverage we've been talking about the last couple of days on this name and the fact that there wasn't a sell-off in the shares or even a meaningful downgrade by analysts, I think that's a good sign. Time to buy Apple.
All right. Thank you. AK, thanks for being with us these last couple of days. And you actually have a final trade for us.
I do. Mine is Alphabet, bets in consumer AI, bets on the enterprise side with Google Cloud. We just saw news today. And then crazy stuff like Waymo that we don't talk about. So, Alphabet.
What do you got?
Quanta Services, growth of electrical infrastructure, and it's not just data centers.
All right, that does it for us. A closing bell special, the next wave in a couple hours. I'll see you then.
Thank you very much, Scott, and welcome to The Exchange. I'm Kelly Evans, and ahead today we're talking a bull market, the cow trade, and how to play a dollar drop. Stocks are drifting higher ahead of tomorrow's CPI report, about 0.25% for the Dow, about 0.4 for the S&P and NASDAQ. Tech is leading the way again as Tesla's rebound continues and the semis jump, and the 10-year yield slightly lower to around 4.47. Meantime, it's the second day of trade talks between the U.S. and China in London. Commerce Secretary Howard Lutnick saying the talks are, quote, going well. We'll see if we get any more updates this hour. But in the meantime, let's talk about the big CPI report on deck for tomorrow morning. Been a market mover lately. Steve Leisman is here with more on that.
Lots of hopes around this report tomorrow, Kelly. Improved inflation expectations in a report we got yesterday from the New York Fed, together with hopes of a contained CPI tomorrow, could create conditions for the Fed to think about resuming those rate cuts later this year. And that depends, of course, on the impact of tariffs and other policies from the administration on prices and on jobs. The least likely cutting scenario, if inflation marches higher and unemployment doesn't decline. The most likely, higher unemployment and stable to lower inflation. And then there's this worst dilemma that we have, higher inflation and higher unemployment, the stagflation dilemma. Some think the Fed would cut even amid that higher inflation and focus just on jobs. But for a time, the Fed will likely wait to be sure tariffs are not spreading to broader inflation. Stable or lower inflation, that can enable the Fed to remove 50 basis points or so of estimated restrictiveness in the rate, and it could cut as much as 100 if inflation heads lower or it's amid stable or rising unemployment. The market, it's built in the middle scenario of 50 basis points in cuts with a tentative, roughly 62% probability of one coming in September, another in December. I would point out that neither one of those shows a whole lot of conviction, just on the other side of 50%. NFIB small business report this morning showed a modest rise in optimism, but the percent of firms charging higher prices and planning to raise prices both remain elevated. If tariffs don't show up in the data, it'll be an important step to clearing the way for cuts, but it'll need to continue, I think, for at least a couple more months, Kelly, in order for the Fed to feel confident to
It's
cut.
interesting what you said about not much conviction on the rate cuts.
Right.
So, as I hear some people, especially those kind of closer, more sympathetic to even the Trump administration, saying, maybe this is not the time to be hammering the Fed because the economy looks okay. You cut rates here, maybe you trigger a run-up in inflation. I don't know if I'm fully persuaded by that argument, but I just find it noteworthy to see it making the rounds.
It's an interesting, I would say, contradiction, in some of the administration rhetoric when it comes to the Fed. You can't be saying 3% growth and the Fed needs to cut. Certainly not, at a 2.5% inflation rate, I don't think. You'd want to bring it down quite a bit. But if you're going to have accelerating, look, there is a potential other side to this story that could be unleashed. Let's assume you get tariffs down to a place where business isn't freaked out by the uncertainty. And then you have some of the other stuff coming from the administration bill, like the expensing from R&D, bringing forward interest expense, that kind of stuff. That could be very helpful to economic growth, in which case the Fed might want to say, you know what, if you're going to go full steam ahead, I'm not going to let up on the brakes.
Right. And so the expectation for tomorrow is what on the core, like 2/10, I think we said?
Yeah, exactly. But
like
3/10, so you might get a
Three.
pop higher in the core to 2.9. Remember, from your old days, you take off a half a point from CPI to get the PCE. So
is it a half point? Okay.
It's about a half a point. So we're real close to the PCE. Not bad. It's been going the right way. The trouble with the whole discussion is just you wait, because the tariff stuff is coming. Right. We're going to have to dissect that report tomorrow, look for any whiffs of tariffs or actual tariff stuff, and whether there's offsetting stuff. If people are paying more for this, it may mean they're going to be paying less for that. So we're going to try to focus on the aggregate demand. all kinds of stuff happening.
Yeah.
Question is, if you're a Fed person, are you feeling lucky? Do you want to roll the dice and say, I'm cutting rates here because I think this inflation is not either going to happen or it's going to pass through, or I need to hold on to the dice?
I think they're just going to be as safe as possible, and that probably means doing nothing until we have a lot more.
You hear a lot of that from Fed officials.
Exactly. Steve, thanks as
My
always.
pleasure.
Appreciate it. Steve Leisman. The markets have meantime staged a pretty strong comeback since those Liberation Day sell-offs. The Nasdaq up 12% from the April 2nd low, the S&P up 6%, and now just 2% away from its all-time high. Our next guest expected what he called a new bull run and was buying at the April lows. So what's he doing now? Let's bring in Keith Fitzgerald, principal at the Fitzgerald Group. Great to see you, Keith. What about the criticism from those who say, he's always buying?
Well, that's a fair statement, but you know what? The markets have an upside bias over time. So the question is not buy and hope. The question is buy and manage. And you can do that very intelligently when there's a big sell-off and emotions are running high.
What were you buying then, and what would you do now?
Well, I tell you what, I was buying companies like Apple. I was buying companies like Palantir, NVIDIA in particular, anything that got hit really hard and where sentiment was overwhelmingly negative. And the reason I was doing that was because I had known my history. When emotions run high, people do the right thing at exactly the wrong time. They sell when it gets low, they buy when it gets high. So you flip that around, you get to work. Today, I'm going to stick to that playbook. We're cresting towards new highs. Some of the best companies are still on the leaderboard.
Yeah, well, the NVIDIA trade, for instance, looks genius, but the Apple one, we're wait and see, I guess. Yeah.
Well, fair statement, right? And that comes with the territory. I've been doing this a long time. And, you take your winners when you get them, and you take your losers, and you take your every once in a while, too, because it's a traveling companion. But a company like Apple, you adopt a longer perspective. What Apple's doing right now, all the disappointment I'm seeing is par for the course. I love it because the company is always on the offense when people write it off.
So if you're supposed to be selling when everyone's buying, what does that mean right now? When a guy like Ed Yardeni, again, sort of like a structural bull on stocks, but even he acknowledges that the list of worries is basically gone at this point, and that I know that maybe the data isn't fully on board with this, but anecdotally it feels like people have become much more bullish on the market.
Well, they're bullish, but there's still a lot of money on the sidelines, right? They're not euphoric. They're not getting careless. The FOMO that I'm expecting isn't yet in the mix. When that starts to appear, then, I'm going to start pruning some of those gains, rebalancing into stocks that want to catch up. But we're not quite there yet, if my read on this is correct.
Let me circle back to Apple because you do, sort of make your point that you don't mind buying and owning it here no matter what the performance has been the last couple months because you liken this more to those moments like 2006, Apple's not a phone company. 2010, nobody needs a tablet. I remember that one particularly well. 2013, services won't move the needle. There's probably even more we could list after that point. What makes you so sure that they're going to figure it out this time around and that the stock, which is currently trading at 30 times earnings, is still going to have plenty of upside?
Well, there's a couple things that are in this developers conference that I really honed in on that I think are very, very telling. Apple's translation feature, for example, that's not exactly happening with conventional programming. The fact that Tim Cook said we can't do liquid glass until we have the computational power. Now that's here. Apple's MO is never to be first into the fight. Apple's MO is to watch what everybody else does, let them spend all their money, and then come in and redefine the customer experience. I think they're making moves that are consistent with that expectation, just like they did with the iPhone, just like they did with the tablet, just like they did with services. So to me, it's a very attractive buy point, even though we are arguably expensive.
All right, but you're not moving to trim anything in the world of NVIDIA, Palantir, from some of the winners or from the market more broadly right now?
Not actively, no. I mean, if I get 100% pop, then I'll use something I call the free trade. I'll take 50% of that off and start buying many times right back into those same names because doing so helps lower my risk, but still increases the profit potential over time.
All right, Keith, for now, thanks. Appreciate it.
Thank you.
Keith Fitzgerald joining us. Meanwhile, the Mag 7 trade, we were just talking about Apple. The Mag 7's become a little less magnificent because of some of that underperformance. Apple down sharply this year, for instance. So our next guest says it's time to go in a different direction with Cow. He believes that these on your screen are the best in-class retailers right now: Costco, O'Reilly, and Walmart. And they'll provide investors a measure of safety and will outperform over the long term. Let's bring in Michael Lasser. He's equity research analyst at UBS. Michael, you sure O'Reilly gets top billing up there with Costco and Walmart? Two of the greatest companies of all time? Welcome.
Thank you, Kelly. Good to be here. It does. These three retailers have a lot in common in that they're sustainable growers, taking market share and generating improving returns. That is why we believe they should be core holdings for those who want to participate in the retail sector. And you are right. We have affectionately referred to them as COW. That is a moniker that we think is appropriate in light of the qualities that these three retailers hold. And they are going to continue to outperform in good and not so good economic times.
And these are names that are already, I mean, people talk and debate all the time about Costco's valuation. Give us your take on that.
So Costco's valuation is clearly a debate. Now, we believe the premium valuation is warranted, both because of the sound execution that Costco has been able to achieve over the long term. Also, it has some unique qualities, such as a disproportionate amount of its earnings coming from this very visible and predictable revenue stream in the membership fees. Plus, a third of its business comes from the Kirkland Signature brand, its private label. If you were to value that business as a standalone entity, it would account for a significant portion of the value. And it's certainly a differentiator for Costco and drives a significant portion of the premium multiple that it trades at.
Right, which is around 51 times. What's Walmart's multiple these days? I mean, the same kind of issue with them, right? And I guess you could argue that that was true for FANG back in 2015 or something, the original thing, that I'm sure it wasn't that cheap, but you could go on to experience years of outperformance. It's just that these stocks feel more mature to me.
They are mature, but they're constantly evolving. For example, one of the reasons why Walmart is trading at a premium multiple is because it's really changing its business model, where it is now gaining a disproportionate amount of advertising revenue that's very high margin and creating a profit windfall for the business that it can use to both let fall to the bottom line and let shareholders enjoy those rewards and have an opportunity to reinvest back in the business to continue to drive growth. These are businesses that have unique advantages that are going to be enduring over the long term. And that is why we're referring to Costco, O'Reilly, and Walmart as the cow trade within retail. And we think investors should be on board.
And finally, one of the amazing things about the FANG or Mag 7 outperformance, I mean, these are literally such innovative technologies that they can create trillion-dollar market caps and innovate like crazy and just really take advantage of the economics of the tech world. What about in retail, right? We don't usually think about it as having those same kind of flywheel benefits, but maybe with the new distribution models you're kind of talking about, the leaders in this field are starting to break away from the pack.
Here's how to think about it in retail, that technology should provide significant growth, efficiency, and productivity to those well-positioned large retailers. Walmart, as an example, is a business that's been around for 50 years. It has 10,000 stores around the world, $600 billion of sales. Think about the opportunity to improve the efficiency of that business through artificial intelligence, robotics, and other forms of technology. So it's not just innovative companies that are capitalizing and harnessing this power. It's also those older companies that have enormous asset base that have the potential to capitalize on this.
All right, Michael. If your last name was Lasso, that would just be perfect. I think it would really kind of bring it all together.
It is very well said, Kelly. Thank you so much.
Appreciate your time, Michael Lasser with UBS. Meantime, the market is awaiting any update from the U.S.-China trade talks in London as day 2 of negotiations is well underway. Megan Casella is at the White House. Megan, what's the latest?
Hey, Kelly, the very latest that we know of is that talks are on a break as of now at the Lancaster House in London, but they are expected to resume just a couple of hours from now, about 8 p.m. London time, which will be just about 3 p.m. Eastern, that they are set to resume for the third time today in, as you said, the second day of talks. So everything that we've been hearing so far publicly from the U.S. side is that things have been going well. The Commerce Secretary Howard Lutnick, when he was arriving this morning, said the first day was very positive. He expected the second day to go positive
positively as well. So the two sides had been spending a lot of time together. We also know the president said yesterday he'd gotten only good reports from the London team, and a White House official earlier this morning told me that the readout after yesterday was that there had been, quote, some progress. So a little bit measured there, but at least things moving in the right direction. But as for the timing, Kelly, we are now well beyond that short meeting with a strong handshake that Kevin Hassett previewed for us yesterday on Squawk Box, far longer than I think most people expected going into this. And that could be simply that they're broadening out from just the two issues that we know have been in focus here. That was export controls and rare earth minerals. Or it could be a reflection of really just how much leverage the Chinese have here, and that there's not a lot of incentive for the Chinese to want to give the U.S. what they want so quickly. That's based on industry sources I've been talking to this week. So Andrew Bishop with Signum Global, this was how he put it. He said the Chinese know how much the U.S. needs these rare earth minerals. He said the U.S. will have seen the reports yesterday that Trump had authorized his Treasury Secretary to ease up on the export controls. And so the upshot then was that the Chinese have every incentive to drive a hard bargain. He defined that as asking for more than simply a reversal of the past 2 weeks of controls. And that could mean things like bringing up, for example, Huawei's AI chip and the U.S. limitations on that chip by third-party countries. So, Kelly, showing you just how much is at stake for these two countries as we await them to get back in place at the Lancaster House, and we wait till we can sort of read the tone and see if these talks might even continue into a third day, which I'm told is possible. We just don't know that yet. Kelly?
You know, I noticed our Eunice Yoon reporting on social media that the tone coming from the Chinese to the Chinese public was a little bit less positive. I don't know what to make of that.
There's so much to read into all of these statements. I think we know what was on the table here was so difficult for both countries because they really weren't broaching new topics. They were simply referring back to what both sides thought they had agreed to in Geneva, and then neither side had been satisfied with the implementation of it. The Chinese side felt that the U.S. was ratcheting up export controls, and they were doing that. They felt like that was a broach of the agreement. On the U.S. side, they really need to see this flow of rare earth minerals that we are very dependent on, that companies have increasingly been making noise about, and they felt like the Chinese had been slow walking that. So I think what's so different here compared to that first round of talks, and this gets into that tone, is that there isn't a lot of low-hanging fruit. There isn't something like lowering tariffs that there was the first time around that would easily make a big difference and generate a lot of goodwill on both sides. Now they're just trying to hammer out things they thought were already settled that neither side is that willing, it seems like, to agree to.
All right, Megan, thanks for now. We appreciate it. Megan Casella with stocks continuing to move higher in the afternoon trade. Speaking of those trade talks, a new piece on CNBC Pro has an options trade on a potential winner from the U.S.-China negotiations. This would supposedly minimize risk while trying to take advantage of some bullish momentum in the name as well. To find out what it is, you can just scan that QR code or head to cnbc.com/ProPick. And coming up, Morgan Stanley says the dollar will keep falling over the next year. Our trader has some ways to capitalize on that, as it's already down nearly 10% since Jan 1. We'll reveal those trades next. Plus, this year's Disruptor 50 list is out, with defense tech firm Anduril taking the top spot from OpenAI. Ahead, we'll speak with number 8 on the list, AlphaSense, about how they're using AI to disrupt the data world. The Exchange is back after this.
This is The Exchange on CNBC.
Welcome back. The dollar taking a breather. Oh, well, let's start with markets, by the way. We're seeing some decent gains drifting higher in tomorrow's CPI report. Probably the best way to categorize that. Again, the blue chips are up 134. The S&P is up nearly 0.5% today. NASDAQ hanging in there as well. Going the other way and maybe supporting some of the positives we've seen in the market is the U.S. dollar. It's down 9% since January 1. And in the dollar world, that's kind of big, especially with Morgan Stanley warning it could slide by another 9% in the next 12 months. Again, that would be nearly a 20% overall drop. But our next guest has a number of ways to play it. Let's bring in Tim Seymour, Seymour Asset Management CIO and a CNBC contributor. Tim, let's just take this at face value, lay out the trades, and we can argue about whether it's really going to happen. But, you know, a big drop in the dollar sounds like it's supportive of everything priced in dollars. So stocks, real estate, Bitcoin, gold, the list goes on.
There's no question that if you're a investor in foreign securities, for example, and the dollar's going lower, you're actually seeing those things going up. Real estate prices, there's a mixed outcome. Commodities, which are priced in dollars, a lower dollar tends to be very bullish for commodity markets. And despite concerns on growth out there, which are the other side of what's been going on with commodities, the weaker dollar is certainly a big beneficiary. So I think there's a lot of arguments that the dollar could go lower. A lot of people look at the move you just discussed and said, hey, the dollar's already had a big move. How much is left? And I think if you take a dollar chart back to pre-COVID, we're kind of right at those levels. I think, you know, post-COVID policy and dynamics with the rest of the world certainly had the dollar having a big rally. But then if you go all the way back to the financial crisis, kind of post-crisis of 08, this has been a 15-year dollar bull market. And an argument is that there's still room lower to go on the dollar. I actually think that there could be.
Yeah, I was going to say, if that's your view or if you're sympathetic with it, what are the trades or investments to make around it?
Well, we have this discussion, Kelly, periodically about international investing. And again, if I would look at owning Euro Stocks 50 or owning MSCI ex-US, this is a 15-year chart that didn't do so well. So kind of the opposite of what we're talking about on an increased dollar. So if the dollar is going to continue to trend lower, and as we've seen, international markets have really outperformed. I run an international ETF, IDEVO, and we are exposed to trends that are not only buying those countries that we think have decent fundamentals, if not great fundamentals, and have valuation discounts and free cash flow growth, but we own some of those subsectors that we think are going to perform very well with a weaker dollar. And that does include not just banks, but it includes industrial metals, it includes global miners, it certainly includes gold. I mean, gold seems to be the all-weather performer here for a lot of different scenarios, but weaker dollar is also great for gold. So I continue to like that. I like copper. Copper, which quietly, despite the fact that Dr. Copper is supposed to be a gauge of kind of economic growth, even at a time when we have some questions about not only U.S. growth, but global growth, copper's near all-time highs. And again, that's a great 15-year chart if you look at it over time. And I think buying integrated miners like BHP, Rio Tinto, but a Freeport-McMoRan, these are names that we are long either in the fund or I am long personally, and I think they are well exposed.
Interesting. Just finally, correct me if I'm mistaken, but there was some poor UK employment data out this morning. Did they actually see negative jobs growth? What's going on there? Does that at all affect kind of your thesis, or were they ever included in the thesis in the first place?
Well, I think as an investor globally, also, when I see the British pound running against the dollar, so actually rallying against the dollar, I actually think that's a bullish sign for owning international stocks. What I think what we saw with some of those data numbers is, look, data markets in a lot of places may start to weaken. I think the UK, a little different than the UK, may see some slightly softer labor markets. I think let's watch these numbers. As we've seen with initial jobless claims here in the U.S., I think these can be some noisier figures. I know we just had a pretty solid job number last week, which gave us some sense that at least if we're not falling apart, we're actually worth rallying around. So I'm not too worked up about that, but I think we're watching the UK. Last week we had the ECB tell us
True.
They're probably done cutting for the foreseeable, which is also, I think, negative for the dollar.
Right. Well, Tim, thanks for now. We'll check back in, but it's been quite a remarkable move here to the downside, especially if it has more to go. Yeah. Tim Seymour, Seymour Asset Management. Coming up, EV execs in China are warning of a looming financial crisis for their industry, one that could even mirror the recent collapse of the real estate giant Evergrande. We'll have those details and what it could mean here at home as well. But U.S. automakers are higher as those trade talks continue in London between the U.S. and China today. Stellantis up 5% now. Ford and GM up 2.5 to 3, perhaps on hopes that they'll be regaining access to some much needed rare earth magnets and so forth. We're back with more right after this. Welcome back to The Exchange. Keeping an eye on markets here. Dom Chu has a closer look at the day's biggest movers. Dom?
All right, let's start off with one of the outsized laggards on the day, Kelly. That's JM Smucker, which is down about 15% right now, far and away the biggest laggard in the entire S&P. After the packaged food company behind brands like its namesake jams and jellies, also Jif peanut butter, Folgers coffee, Milk-Bone dog biscuits, you get it, reported quarterly results that missed expectations on both the top and bottom lines, due in part to weaker results from its pet foods, baked snacks, and frozen handheld and spreads businesses. It also forecasts full-year earnings that came in notably lower than consensus as it deals with the effects of tariffs, changing consumer behavior, and input cost pressures. So the biggest loser in the S&P, JM Smucker. Meanwhile, on the tech front, shares of Taiwan semiconductor manufacturing are higher by roughly 2.33% after the world's biggest contract computer chip maker that counts tech giants like NVIDIA and Apple as clients reported sales figures for the month of May that were nearly 40% higher than the same time last year, perhaps indicating that demand remains robust for high-end artificial intelligence and data center semiconductors. Keep an eye on Taiwan Semi. And we'll cap things off with a notable analyst downgrade, hitting shares of McDonald's to the tune of about 1% right now. The quick service restaurant giant and Dow component is down after analysts at Redburn Atlantic double downgraded shares to a sell rating. It was a prior buy. They're citing things like declining foot traffic, concerns about pricing and growth expectations, also the effect of obesity drugs on consumer demand. So keep an eye on that. And by the way, if you want more on that story, just head over to cnbc.com/pro. Subscribers get the full story, Kelly. I'll send things back over to you.
Going out on a limb, it's up 18% over the year. Dom, thanks very much. Dom Chu. Let's get to Bertha Coombs now for the CNBC News Update. Bertha?
Hi, Kelly. Cost of deploying troops to Los Angeles amid the immigration protests will likely be about $134 million, according to the Pentagon's budget chief who briefed Congress today. The president has ordered 4,000 National Guard members and 700 Marines to L.A., a move California Governor Gavin Newsom calls unnecessary and a step toward authoritarianism. President Trump said moments ago that any protesters at the Army's 250th anniversary parade this weekend in Washington will be met with, quote, heavy force. Army officials are expecting close to 200,000 people to attend Saturday. In preparation, more than 18 miles of anti-scale fencing will be erected. And the Wall Street Journal reporting that throughout 2022 and 2023, several government agencies tracked foreign nationals visiting Elon Musk's properties. According to the Journal, citing people familiar with the matter, the probe focused on people visiting the tech billionaire from countries in Eastern Europe and elsewhere who might have been trying to influence Musk. Back over to you, Kelly.
All right, Bertha, thank you. Bertha Coombs. Meantime, shares of BYD are climbing in Asia today, up more than 50% this year now, which is outperforming Tesla. BYD launching its new Seal 6 vehicle for just $15,000. Again, that's about half the cost of a Tesla Model 3 in that country. But ongoing price wars in China, these EV price wars, have some insiders worrying their whole sector could end up facing a crisis of epic proportions. Eunice Yoon has that story.
Fears are growing in China that its EV industry is in a race to the bottom.
Outside of China, this country is often accused by its trading partners of flooding markets with cheap Chinese EVs. These days, similar accusations are flying within China about China, raising concerns about financial stress in the industry.
The company drawing the most fire is China's market leader, BYD.
BYD slashes prices by as much as 34%. This mini hatchback, the Seagull, now costs only $7,700.
The intense price war has sparked high-profile auto executives to sound the alarm, with the head of Great Wall Motor calling the industry unhealthy. In a local media interview in late May, Chairman Wei Jianjun drew parallels to China's moribund property sector and its now defunct poster child, developer Evergrande. An Evergrande-like crisis already exists in the automotive industry, he says. It just hasn't erupted yet. BYD has dismissed Wei's comment as alarmist. Sellers at this used car market see another sign of strain.
The authorities are looking into a phenomenon known as zero-mileage used cars. This is when cars are registered and plated and then marked as sold, but they haven't ever been driven.
Used car salesman Ma Hui is worried where all the competition leads. All of us were losing money last year, he says. There are too many companies making too many new energy cars.
The sellers told us that that tactic of zero-mileage used cars is meant to help car companies and dealerships artificially inflate their sales volumes. It's one of the reasons why the official Communist Party paper, The People's Daily, said that the price war leads nowhere. Kelly?
Eunice, I'm so glad that you're diving into this story. So it's not just in China either, where there are implications. Look, whatever happens to the industry domestically, it's great for consumers, frankly, in the meantime. But for global auto producers, right? I mean, if you're a major European car maker, if you're Tesla, I mean, how are you supposed to compete with this?
Yeah, it's very difficult for a lot of these car makers to compete, and it's I think it's questionable as to whether or not we're going to see an end to this. I've talked to a couple of people who said, in theory, you would see a shakeout of the industry here, but the industry operates quite differently. The incentives are different. A lot of the car companies have local governments behind them that are financially helping them for reasons because they want to have jobs, because they want to have bragging rights that they have their own car company. But then the incentives are that they allow these producers to continue to produce and then sell onto the international market rather than go bankrupt. And then, of course, the whole model that BYD is approaching is something that we see quite often with Chinese companies, and that is depressing prices a lot in order to gain market share. But by doing so, of course, that distorts a lot of the market for other players.
No, I think it's one of the top three, like literally most consequential economic stories going on the planet right now. Appreciate you shining a light on it. Eunice, thank you very much. Our Eunice Yoon in Beijing. Coming up, AlphaSense is number 8 on this year's CNBC Disruptor 50 list, up from number 40 last year. Nearly 90% of the S&P 100 companies are among their 5,000 clients. Next, we'll ask the co-founder and CEO how they're using generative AI differently from the rest of the field. Before we head to break, check out shares of Snap seeing a small pop on news that they will launch a new lightweight immersive pair of smart glasses next year. Snap nearly up as much, about 1/3% right now. Big pop earlier. They're still trading around $8.53 a share. And again, innovating on the technology they arguably pioneered. We'll be right back.
Plus.
Welcome back to The Exchange. Our next guest company counts the likes of Amazon, Nvidia, Microsoft, and JP Morgan as clients. No big deal. AlphaSense uses AI-powered tools and a huge database of content to provide securities market intelligence. And they come in at number 8 on CNBC's 2025 Disruptor 50 list. Joining us now is AlphaSense founder and CEO Jack Coco, along with our very own Julia Borson. Coco?
That's right.
Oh, Coco.
Thanks for having me.
Okay, thank you, Jack. Congratulations. Julia, tell us, what do we need to know about how AlphaSense vaulted from number 40 to number 8 this year?
Well, you had some very exciting news today. You've been doing this market intelligence for a while, analyzing all sorts of different public sources of information, analyst calls, et cetera. But tell us about this new launch of deep research. What does this mean for AlphaSense and for your clients?
Well, we're really excited about this launch. What it does is it takes a multi-step prompt and does planning to execute something that would have taken a human analyst days or even weeks. I know this. I was an analyst before in my career, and it's amazing to see how this basically does the same planning, same execution of the research steps, evaluates the results, looks at whether it's really completed the work, and then once it's satisfied that it's turned over all the stones, it's going to come back with a thorough report, still precisely cited, so you can go and read the underlying information and really get the understanding you need when you're placing large bets. Millions, sometimes billions of dollars are being invested on the back of the information that this gathers for you. So it's really incredible way to get deep dives into companies, industries, and projects. Recently, a private equity firm told us they had spent weeks doing research on an industry, and they ran a deep research report, and it did the work at the same or even better quality in their view. And you can imagine if a company has this kind of capability at their fingertips,
you can probably charge
all
them.
decisions.
I mean, God knows. Can you talk about what you're charging people, or are there many different tiers?
There are many different tiers. There are enterprise deals that go into the millions, and there are much smaller deals when you get started. So it's really a sort of a scaling pricing system that starts low and grows.
You're competing with so many different players. You have the incumbents like Bloomberg, Thomson Reuters. How does your AI and now this new AI of deep research differentiate your platform and allow you to compete? And what's your competitive moat?
Well, first of all, it's our incredible technology that we layer on top of the world's most comprehensive collection of content. It's both the company's internal content. So we allow you to securely bring your internal content into the system.
Oh, really?
And then we combine that with a really broad library of high-quality external sources, from sell-side research to expert interviews. We acquired a company for nearly $1 billion last year, the market's preeminent library of expert interview transcripts, almost 250,000 transcripts that really go deep into every company, every industry. You might have 100 interviews on a single company where no human can normally read all that, but our deep research will read everything, and it can answer questions based on all of that. And so it can really give you perspectives from multiple perspectives in a way that no other product can. It's really a well-rounded
CNBC's
perspective.
whole library on there. That's what I want. I want a CNBC sort of like chatbot.
That is a perfect idea.
Yes, it is. It's a great, because then you can go and say what's been said about, I don't know, pick your topic, right? And kind of go back and look and come up with all the narrative. Because what I like about you in this new world of generative AI is you can be imprecise, right? It used to drive us all crazy in the past. We would say, well, how many times were tariffs mentioned on earnings calls? You have to put in tariff, the word, in quotes or something to that effect. These models are a little bit smarter. They can pick up on the things that might reference what you're looking for without explicitly naming it.
Exactly, and that's the beauty of it. You don't want to miss information just because it was talked about in a slightly different way, in a different part of the world or in a different language, or just it's really powerful. The machines are able to bring us the information, and we can trust that we've covered all the ground we need to cover.
Just curious, so do you use proprietary AI large language models? Does that involve you with things like NVIDIA chips, or is all of this outsourced and you're just like a layer on top?
Well, it's a combination. We use a suite of language models, actually many of them. We've really customized this on a task basis. We find the best model for a given task, and we can swap them out if a better model comes out. And it's really an orchestration system that is able to give the best result for users based on the best technology, the best models out there.
Why hasn't Bloomberg, go ahead, Julie, but why hasn't Bloomberg done something like this yet? Or maybe it's in the works, or because these all ultimately feel like competitors with like that data repository.
I think this is very, very hard to build. We've been at this for a long time and building the underlying knowledge graph and building these really rich data sets that our technology is drawing from. Your guess is as good as mine.
And I want to understand your impact on the industry, because Goldman Sachs has been an investor in Alphasense since 2021. And when you describe what your tools do, it seems like it's going to replace a lot of jobs at firms like Goldman Sachs. How do you see your technology impacting the jobs at your customers?
Well, that's definitely a popular narrative, but I wouldn't be so sure. I think what it does is it makes human analysts and business people so much more productive that person is that is deploying this technology is going to be operating with such high ROI that companies don't cut high ROI assets; they invest more in them. I think the fallacy is that people don't really see the top line growth, the enterprise value expansion that comes from being able to do things so much more efficiently and in a much more agile way that comes out of being able to leverage technology in this way where people can be sort of 5x, 10x of their prior productivity and intelligence, really, when you combine your own intelligence with the machine.
Yeah, Klarna's talked about the same thing, that they've shrunk the headcount, but their existing employees are generating higher. I look forward to our free AlphaSense accounts. I think it'd be great if you help boost our ROI too. That would be wonderful.
You're a knowledge professional, right in the core of our focus.
I'm sure you could go up to a sales meeting next year, I'm sure. Bruno, congratulations again, and really appreciate it. Thanks for joining today.
Thank you.
Julia,
Thanks for
bringing that to us. Much more of Julia's coverage. The Disruptor 50 continues all day long. And don't miss our interview with Palmer Luckey, founder of the #1 company on this year's D50 list. That's coming up at 4 p.m. Eastern on Overtime. For the full list and to read more about each name, just scan that QR code or head to cnbc.com/disruptors. Still to come, a mixed bag for the vaccine stocks after HHS Secretary Robert F. Kennedy Jr. fired everyone on the CDC's independent vaccine panel. We'll talk about what's at stake for the vaccine makers next. And shares of JP Morgan are higher, with the CEO Jamie Dimon at a conference saying they'll continue to buy back stock. It's turned the shares positive by about 0.6%. We'll be right back.
Rated PG.
Welcome back to The Exchange. Health and Human Services Secretary Kennedy doing a clean sweep of the CDC's Independent Vaccine Advisory Committee. He argues the 17 members had conflicts of interest and is vowing to, quote, restore public trust in vaccines. Our own Angelica Peebles is here on set to discuss. And Angelica, in a weird way, it reminds me of the Elon Musk thing. Like, he sort of has to bring the half of the public who's skeptical on board without alienating the other half of the public who now becomes skeptical because of these moves.
Yeah, that's a fair comparison, I suppose. But definitely there is a lot of concern about this sweep because, yes, there is a lot of mistrust right now in vaccines. But I think people are concerned about just getting rid of everyone and saying that everyone has these conflicts of interest when really, when you look at the website, they have to disclose their conflicts. And if they do have any perceived or potential conflicts, they have to recuse themselves from any votes or discussion. And when you look, there was only 3 conflicts disclosed last year. So it's really not a whole lot. But then, of course, you do have some people who are skeptical of vaccines out there cheering these moves. So definitely some mixed reactions to this.
I also heard he described this as no longer being a rubber stamp. I'm not sure what that means exactly, if it means the vaccine approval process is about to get a lot rockier for existing players or if it's just in a particular areas of reference. Apparently, he has a month now, right, to fill these positions before the next meeting of said committee. And I think it'll be very telling. Look, the move to get rid of all 17 is one thing. Who replaces them now becomes the major question.
Exactly. And he actually only has 2 weeks because they are supposed to meet at the end of this month, June 25th. That's 2 weeks and 1 day from now. And from what I've heard, the plan is to have those new members. And that's exactly the question. Who does he put on this panel? Is it a bunch of people who are skeptical of vaccines, or does he have, people who are vaccine experts and policy experts? And that is really the question. Now, it's important to note that ACIP, they don't approve vaccines. That's the FDA's job. But ACIP is instrumental in deciding who should receive vaccines and when.
I see.
So, for example, the RSV vaccines. At first, they went along with the FDA's approval for adults 60 and up. But then, after seeing some more data actually about some safety concerns, they narrowed that to only adults 75 and up, and younger people could get those vaccines, but if they were at higher risk. So those recommendations change, and those recommendations are key to insurance coverage. So as it stands now,
all roads always lead back to insurance coverage.
Always. And they're required, as it stands now, to reimburse for any ACIP recommended vaccine. And so if you don't have those recommendations, then the question becomes, will they be covered? And if not, will people pay out of pocket?
So in other words, let's say ACIP becomes slightly less likely to broadly recommend new types of vaccines going forward, then the vaccine makers might sell off because they say, well, the public would have to foot more of the bill and maybe do less of it. Although I didn't see much of a move in the vaccine names today, or what are you seeing?
Yeah, we haven't really seen a whole lot of reaction. And I think there's been such a pullback so far. A lot of those vaccine stocks have been down since Trump came into office, that maybe you're starting to see a little bit of a numbness to this, and also at the same time, some more clarity about what to exactly expect from this administration.
With Moderna already down so sharply year to date, for instance. For now, Angelica, thanks. Angelica Peebles. Coming up, Meta shares are higher today as the company makes a big bet on another one of CNBC's Disruptor 50 names, Scale AI. It also doubles Scale's most recent valuation. Meta shares up about 0.4%. We'll dig into the deal right after this.
marketbuzz.com.
Welcome back. There's always some news on the AI front, and today we have Meta paying $15 billion to buy a stake in Scale AI. Deirdre Bosa here to explain in Tech Check. Go ahead, Dee.
Hey, so a source familiar with the deal confirms to me that Meta paid nearly $15 billion for a 49% stake in the startup. I also got some color around incentives. The source says that this is more about Scale AI founder Alexander Wang and his AI network, less about the data labeling part of the business. Now, Wang is just 28 years old, seen as a darling himself in the world of AI. He built critical infrastructure early on, and he has ties to both Silicon Valley and Washington. Early backers include VCs like Founders Fund and Accel. Scale has worked with OpenAI and Meta, other model developers, and it secured Pentagon contracts early, positioning itself as a key player in the government's AI strategy. Meta, by contrast here, really seen as falling behind in the AI race. So the Scale AI deal seen as a way perhaps for Zuckerberg to get more credibility as he tries to turn around their own efforts, especially if he can bring Alexander Wang into the company. Now, the company, Meta, has faced key talent departures, including top researchers defecting to startups. It's also been plagued by delays. And unlike a Microsoft or Google, Meta, of course, doesn't have that enterprise channel or cloud platform to really monetize AI, even though it is spending a much higher in terms of CapEx to revenue percentage-wise. Now, the Scale AI stake, that gives Zuckerberg a new entry point and a tighter tie to infrastructure that Washington, Silicon Valley, and the AI startup ecosystem are increasingly depending on. Kelly, the information reports that the deal will value Scale at $28 billion. That's double its last valuation a year ago. And on that note, you said there was a lot of AI news going on. It's true. Another disruptor 50 company, Glean, I was reporting this morning, just raised a round valuing it at more than $7 billion, up 50% from about 9 months ago.
Wow. As it continues, it will continue apace. Deirdre, thank you very much. Deirdre Bosa. And that's it for us here on The Exchange. Stocks just off session highs. I'll join Brian Sullivan for Power Lunch right after this quick break.
Stocks higher again as we close back in on record highs. Welcome to the show, everybody. I am Brian with Kelly Evans. Here's what's new at 2. 3 key questions and why they matter to you. I didn't even try to rhyme. First, could today be the make or break moment for the U.S.-China trade talks? Then, can Meta, Facebook, learn from Apple's AI mistakes? And finally, is the IPO market surging again? We're going to get you the answers to all of those straight ahead.
But first, let's get you a check on these markets. The Dow is up around 100 points. The NASDAQ 100 closing in on some record highs. We're generally drifting higher ahead of the CPI report in the morning, but we were well off the session highs we notched just about an hour ago. Energy is leading the S&P, interestingly enough. Enphase, APA, Schlumberger, SLB, I think we call it now, up 4 to 5%. Big moves the other way in the consumer space with Smucker's falling on a revenue miss. That's leading the decliners in the S&P. It's down 15%. Avocado distributor Calavao also plummeting on some weak results. Haven't talked about that one, Brian, in a long time. And McDonald's lower after getting 3 downgrades in 2 days. One standout, though, Casey's General popping on an earnings beat. Those shares are up 11%.
All right, so there's obviously a lot to get to, including apparently an avocado story. But let's begin with the trade talks between the United States and China. They are a bigger deal, and they are underway in London. Commerce Secretary Howard Lutnick saying they are, quote, going well. But there still is no firm deal. And really, until that happens, the market, you, may not entirely trust some of the words today. And really, the next few days could be make or break moments. So let's make you smarter about what is really at stake. Joining us now is CraneShares CIO Brendan Ahern. And on set with us here is MCC Global Enterprises CEO Michelle Caruso Cabrera. Do I have to say you're also a CNBC contributor? Isn't that
if you like.
Assumed, well-known, global celebrity? What's at stake here in London? What's a win?
Oh, well, so first of all, the way the markets are acting, they think a win is coming, or at least things will not get worse from here when it comes to the trade war.
But they could.
And they could. Well, if they do get worse, right now the market's off sides, right? Because it's been steadily climbing. It appears we are in a period of de-escalation. We got that from Kevin Hassett yesterday, where he outlined the shape of a deal right here on CNBC. We heard it from Howard Lutnick as he got out of the car in London. They're sending all kinds of signals that things are going on a glide path that's more positive than it was. So when it comes to trading the trade war, right now that pressure is off. It could, if everybody's wrong and they come out and say this thing fell apart, of course you're going to have a sell-off.
I had a viewer and CEO come up to me on Saturday and ask me a really smart, as all of our viewers are just so smart, simple but important question. Is the White House still able to screw this up?
I'm surprised he's even asking.
Could they still botch? Because to Michelle's point, the markets have come roaring back, up 25% in a month, 2 months. Could they still botch this trade negotiation?
So what we don't know is what ultimately the White House wants. They haven't made that clear. And that's not a criticism. I think that's part of their method here, is to keep things close to the vest until and to figure out what they can get out of the Chinese. But I don't know, do they want more production here, really? Do they really want the Chinese to change some of the way they do investments in the country, so balance of payments shift, so that way we have less of a trade deficit? It's not clear to me exactly what they want, and I'm sure they're not telling everybody what they want, because they want that strictly for the negotiation. So depending on what they want, I suppose if they don't get what it is.
I think that's exactly right. Brendan, I'm curious if you want to kind of take that ball as well. What outcome here do you think we're heading towards? Does it matter if all the signs are just simply positive that more or less the status quo will remain? We'll work out some tensions on whatever the key priorities are for each side, and stocks will continue to rally in the face of that.
No, I mean, we believe President Trump is a business person at heart, that he certainly wants to see U.S. businesses succeed in China. And obviously, a lot of U.S. multinationals, many of which have visited the White House, have probably explained that to him. So I think, this is a little bit of the art of the deal, but I think that's, at least there's communication and dialogue, something that really didn't occur under the Biden administration. And so I think, they're making small steps. There's areas where I think they can make small deals, which hopefully then lead to bigger deals, things around fentanyl, issues like the rare earths, semiconductor exports, and ultimately the potential for a Trump-Xi summit, I don't think should be underappreciated. I think it's something that could actually happen this year.
Yeah, that could be a future catalyst in June. They keep talking about the birthday summit because their birthdays are so similar, and they happen to be in the same place at the same time. So that could also be a place for progress.
But is this? Let me paraphrase Brian's question again, which is we have this anticipation about what birthday summit or what could happen. Kind of happy talks from both sides, although maybe a little bit less on the Chinese side. I mean, is all of the good news already priced in here? And could we wake up to another nasty surprise in the form of a tweet or otherwise, where we're going back down the road that we were on kind of pre-April 2nd?
Yeah, I think it's certainly feasible. I mean, we are still in this 90-day truce period, but I think a lot of on U.S. equities, certainly they've performed very well over an extended period of time. Where I think for us, kind of investing on the Chinese equity side, we think this geopolitical headwind, if we can make some progress, it really takes some of those handcuffs off. And we really do believe, despite the year to date, despite the strong performance of KWEB over the last year and a half, we do think there's significant upside to Chinese equities based on valuations, where I think for U.S. equities, it potentially needs a trade deal more because of the higher valuations today.
Who has more to lose here, Michelle? Us or China? Who has the leverage?
I've always believed China has more to lose than we do. We have a much more dynamic economy. We have many more choices. We are far less interventionist in the economy compared to the Chinese. The Chinese have a weak economy because of self-inflicted wounds, where they continue to be deeply involved in distribution of capital, so the best companies don't get the money. They are so reliant on trade. They have, I believe, far more to lose. Do they have points of leverage when it comes to rare earths? Yes. But price draws commodity to the markets, and we have dynamism where we can eventually replace those things.
But if they have more to lose, why have we backed down and seemingly gained nothing?
Oh, I don't know that we've gained nothing. I don't know. I mean, I think China's going to end up with much higher tariffs on them than when they started out. And I think they're also going to have to, at some point, kind of look internally and say, okay, what are we doing to actually fix our own economy? And the more pressure we put on them, the more pressure they face internally.
Right. We just saw that report by Eunice about all the excess production of EVs, for instance, which, again, great for the consumer.
Which is driven by government intervention.
Totally.
And
right?
cheap labor. By the way, everyone's like, look what China's doing with the BYDs. Yeah, if you have people working for $1 an hour, you're going to make a cheap car. By the way, a disposable car with really bad battery stuff. That said, Brendan Ahern, the Chinese stock market has been on fire. Why?
Well, I think, one, we had a derivative-induced meltdown in January of 2024. And since then, KWEB's done twice the performance of the S&P 500. So I think you're seeing a little bit of a re-rating taking place. Some of that's driven by DeepSeek, as well as the Chinese government is stimulating their economy. They're trying to deal with a housing crisis. But I would say I would disagree that China has more to lose. I think that's why they're the only country that's retaliated against the tariffs. China's far less reliant on exports than I think. Most people think that 1.4 billion Chinese people are sitting around making these things, and that's just not true. Over 50% of China's GDP is driven by the service sector. Less than 12% of their GDP is driven by export-driven manufacturing. And then if you apply that to what percentage of Chinese exports go to the U.S., we think less than 3% of China's GDP is directly geared to the U.S. economy. Conversely, the U.S. economy, 2/3 are personal consumption expenditures. So I think going into this trade war, the Chinese government had done a lot of work knowing that the U.S. economy, as a consumption economy, is potentially more reliant on China than China is relying on the United States.
The one thing I would add when it comes to the Chinese stock market is, remember, you have the home team. Like, they literally have the government team in there buying stocks. There's just data out today. The Financial Times published it, that the Sovereign Wealth Fund, an arm of it, has bought something like $1 trillion worth of stocks. I mean, they are working very. Now, that's good if you're buying Chinese stocks.
It's a good reason not to bet against China stocks.
Exactly.
Because we joke around about the plunge protection team right here in the United States. Well, the Fed step in. They actually do step in. I guess it's the power, what do they call it? The velvet fist or the iron glove or whatever it is?
No, they admit it. They admit it, that they go in and they have, arms of the government buy stocks because they want to support the stock market. They're also seeing it as a measure of success. So, you don't necessarily, we don't fight the Fed here. I don't think you want to fight that trend in China for sure.
Good stuff. Good discussion. Certainly a lot at stake. Brendan Ahern of Crane Shares, thank you. Michelle, thank you.
And before the break, want to flag some moves in the drug makers. HHS Secretary RFK Jr. abruptly firing the CDC's vaccine policy panel. Pfizer and Merck shrugging off the news are up higher by 1% and 2% today. Moderna down 2.5%. It's had a much harder year. In the pharma space as well, we have Insmed shares surging on positive results for pulmonary arterial hypertension. You heard that right. INSM up 27% today.
That's a good way to relieve hypertension. Have your stock rise 27%.
Or maybe get a different kind of hypertension. As we go to break, just like we saw with Apple, companies have a lot to gain with AI, but also a lot to lose. We'll highlight some of the winners and losers and who could be set to cash in next. Stay with us.
Card for a free quote.
Welcome back. Yesterday, Apple learned a tough lesson that AI isn't just a buzzy word right now. Investors really want to see real results, and the company is failing to convince them it's making substantial progress on AI development. Barclays says they weren't expecting much, but were still disappointed. UBS says announcements were more evolutionary than revolutionary, and Goldman directly called out Apple's limited AI updates. Turns up the pressure from Meta, who is also at risk of falling behind. In response, Mark Zuckerberg creating a new AI lab pursuing superintelligence. But as with Meta's last big bet, the metaverse, will Zuckerberg miss the mark here as well? Let's talk about it all with Daniel Newman, the CEO of Futurum Group. Daniel, I don't know if I'd go so far as to say that Meta's behind. I mean, there's clearly some internal drama, but they can look, they have Llama. There's tons of companies developing on top of that. Maybe they just need to monetize it. They are using their own AI to optimize ad spend, which is music to investors' ears.
Yeah, good afternoon, Kelly, and thanks for having me. First of all, I think you're absolutely right. I don't think they're missing the mark in the same way. You could say both companies, Apple and Meta, are challenged, but the challenges are very different. One, it's like, are they going to become the Kodak or the BlackBerry of AI era? And the other is kind of like, are the scaling laws and the challenges of acquiring the right talent going to be some sort of ceiling on their continued development? Meta is making massive investments. Just the scale AI investment alone that we are hearing that it's going to make, that likely will be a deal that's going to happen, is going to continue to push it forward in terms of training their behemoth models and continue to evolve. But yeah, they've basically built the rails for open source AI development, and so much of what is happening in AI is being built on Meta.
Yeah, I just can't imagine that's a negative for them in the long run, whatever they are scrambling to catch up with now with scale and all the rest of it. Apple's probably a harder one. I mean, it's more obvious that there's not, a clear competitive play there. Although in a very simplistic way, I'll just say the more I use ChatGPT on my phone, the more, the husband's trying to not use the iPhone and he can't because he's using ChatGPT all the time, as a small anecdote.
Yeah, I think the ability for them to use their sort of app ecosystem to deliver us AI is great. They have 2.4 billion install user base. And I think one thing that a lot of people need to understand is that does buy Apple some time. The problem is it's been a year now. We heard about the super cycle. We heard about Apple, in the new devices going to drive this future of AI and Apple intelligence. And most of the AI we're experiencing on Apple right now is other people's AI, which means it can move to other devices. It can move to an Android. We saw what OpenAI is doing with Joni Ive and IO. They're thinking of the future, new devices. And we say that Meta missed the metaverse, but you could say Apple missed it too with its, Vision Pro. It hasn't hit. I actually think Meta and their Ray-Ban glasses are closer to that kind of future form. So will we wear it? Will we wear it on our eyes, on our chest? Will it be a handset or device?
And
overall, Apple right now, they did a bit of
and Daniel, I'll add to that. It might be even worse because Apple's main design guy, Johnny Ive, who's created with making the iPhone, making the iPod, making all these great things, he's now working effectively for the competition. With OpenAI and that deal that they made for I think over $6 billion for Ive's company. So not only does Apple not have that, they actively have potential competition from their own long-term guy.
Yeah, it felt a little bit like everything that Apple rolled out was a bit of a parlor trick. It was like, look over here, we've got a new design platform.
Yay, translucent icons or whatever.
Yeah, meanwhile, OpenAI is spending $6 billion because they believe the hardware AI integration is going to be completely revolutionized in the near future. And like I said, Meta, and if you listen to what is being said about the inside of Meta, is basically Zuck is back in founder mode. He is basically bringing the smartest, highest talent, potential people in his little inner sanctum to create the future. He understands what's at stake. It can be the big multi-billion-dollar data centers they're building out, the power expansion, what they're doing with Llama. He's investing big. Like I said, two very different problems. And Apple doesn't have that founder. They don't have Steve Jobs, of course, and they don't even have that design leader right now. It just feels like they're a little bit lost. Meta's probably.
Can you imagine? Can I posit something?
Scale law.
Can I posit something? I don't want to be clear. I'm just, look, we're having fun here. I'm not saying this, but yesterday, Dan Ives on Halftime Report said Apple may have to do a deal because Apple normally doesn't buy companies. That's not their DNA. Couldn't Apple buy a Meta? I know that sounds insane, and Zuckerberg controls the voting stock, so they would never have to sell. But if they start to fall behind, I could see something massive like that happening.
Well, Brian, we are having fun. I don't think a regulatory
We're just having fun here.
Yeah. I don't think a regulatory body would ever let them through. But I will say I've been on the record. I've suggested Perplexity, a tool that's being used and growing very, very quickly. A deal like the one that was just made with Meta and Scale to help Apple. Apple's putting out papers right now saying that LLMs and reasoning don't really work. And what they said wasn't entirely wrong about the challenges. But having that come out and then having a WWDC like they had and not really addressing the fact that intelligence has been a total flop, it more sounds like, oops, look over here, because we don't know exactly what we're doing while all these other Mag 7 companies are building humanoid robots, are building massive data centers in the future, are building the actual networking and GPUs. Apple is like, oh, we have a lot of users and they love our stuff, but they have to figure out how to turn that back into growth, back into revenue. And it's pretty scary right now seeing all the analysts come out and basically nobody, even you mentioned Dan Ives, even Dan wasn't impressed. And he's got to be the most bullish person on the street when it comes to Apple.
He likes it. Hey, Mikey. Yeah, it was kind of like that moment, you know?
Yeah, no, it's true. Daniel, appreciate it today. Thanks for your time. Daniel Newman with Futurum.
All right, before the break, check out shares of Microsoft. Speaking of AI, Microsoft is actually down a little bit right now, down about 1%. Why are we showing this to you when it's not a very big move? It's because Microsoft is in the middle of its longest winning streak in about a year and a half. So today would break that winning streak. So again, not a big move by Microsoft, but if it declines, Kelly, then rip the streak.
I love a good streak. Let's make it 9, folks. Come on. Got a few hours left.
It looks like the streak may have been struck. We'll find out. All right, on deck, has the Big Mac's big run finally gotten fried? Sorry. We're going to look at a story that's hot off the grill next.
Plus.
All right, welcome back. You can see the markets are very, very slightly higher again right now. If you're on the radio, you can't see anything, but the S&P 500 is up 0.2%. Again, not big gains, Dom Chu, but that with these gains, every inch higher, the NASDAQ 100 and the S&P close back in on their record highs.
Stone's throw away.
A stone's throw, and it all depends on the size of the stone and who is throwing it. The NASDAQ got 1.5% from its record high. And here's what's amazing. 25%, that is the gain of the S&P 500 and NASDAQ 100 since the April 7th trade and tariff 25% in 60 days. Right. That's even more amazing than Cornell winning the lacrosse national championship.
You know, I'll tell you what, the V-shaped recovery has been the name of the game ever since the wake of the great financial crisis back in 2008, 2009. But this has been a rapid ascent for the market overall.
Rapid
It's
recovery.
Absolutely crazy right now. But apparently all of that movement to the upside is not amazing for McDonald's shares. That stock is still higher this year, but it just got another downgrade, and that's the third time in just 2 days. So is it time to dump on the old McDonald's Mickey D Golden Arches trade? We are going to now talk about what's happening with McDonald's and Redburn Securities, Redburn Atlantic, double downgrading the shares to a sell from a buy. They also slashed their target price. Now, it marked the third downgrade for McDonald's in less than a week. Our next guest says he would not short the stock, but thinks these cuts could provide traders a good entry point to actually buy some shares amid the weakness. Navigation style. Joining us now is Tony Zhang, chief strategist over at Options Play. So, Tony, the McDonald's trade, it's a Dow component. One of the reasons why we're seeing a little bit more of that relative weakness in the Dow. What exactly is your McDonald's thesis, and why do you think this is a dip worth buying?
Yeah, more specifically, I think this is an opportunity that generates a little bit more interest in this particular stock. You know, implied volatility on options are higher, and I think this is an opportunity to actually pick up some of the stock by selling some put options on McDonald's, because, you know, the downgrades that you're referring to over the last few days, I don't particularly think that they represent a meaningful change in the outlook of this particular company. I think you have to remember McDonald's, you know, trades at around 25 times forward earnings. But if you look at net margins here, you know, they're north of 30%. So I think from a valuation perspective, McDonald's is at very fair value, if anything, even slightly undervalued, especially if you compare it to the overall restaurant group. So I think given kind of the business, I don't particularly think that, you know, McDonald's entire business is going to be shifting, you know, much very soon. And I think for those reasons, the valuation that's currently trading at is very reasonable. And then also you see that, you know, despite the downgrades, McDonald's still continues to hold that 200-day moving average. It's holding that $300 psychological level. It's holding the 200-day moving average. And I think for those reasons, you know, the sell-off that we've seen here, the small sell-off we've seen here over the last few days, you know, represents an opportunity for option sellers to take advantage of the elevated implied volatility, sell some options with the opportunity to potentially pick up some shares, you know, in the high 290 range or so.
All right. Tony Zhang with the play on McDonald's shares. Thank you very much. We'll see you again soon, Tony. This is interesting. To take advantage of the volatility to sell options means you actually take in more premium than you have in the past on a relative basis. But you got to be comfortable owning the stock at a certain point lower if you get put or assign those two.
I know there's people that say, why do you focus so much on McDonald's? Folks, it's not about McDonald's. It's about they're a Dow component. They're the biggest restaurant chain, one of, in the United States. And kind of a, I don't know.
They're a battleground. And they're a battleground.
Are they a battleground?
I think they are.
You're making the call right now. They're a battleground.
They're a battle. Love is a battlefield, and this is a battleground.
Easy, Pat Benatar.
GLP-1 versus fast food versus all of the macroeconomic cycles.
I know which one's winning over here.
I know for me as well.
I do love the Pat Benatar reference, though. That was strong.
Well, I'm old. I'm getting
old. You know Lita Ford, though. Kelly, back to you.
Thank you both. Still ahead, temperatures are heating up, but your energy bills could get even hotter, too. We'll explain why right after this.